So integrity, effective communicators, good with technology. They should be good at building collaborative relationships, always willing to learn. They should leverage on data analytics. They should be innovative, team-oriented. They should understand business risk. Okay, we shall be studying risk soon. But business risk is anything that impedes an organization from achieving its objectives, impedes an organization from achieving its business objectives. Okay, we shall be looking at risk. Okay. So if you look at Matt Abacus Business School, what are some of the business risks here? What could be some of the business risks facing Matt Abacus Business School? Anything that impedes an organization from achieving its business objectives. So give me some examples. At least 5 risks that a business school like Matt Abacus faces. What? Understaffing. So limited staff, correct. Competition from other business schools and colleges. I'm listening. I'm waiting for another 3 and I move on. What else? Limited space. This is here. What else? What? Which systems? Which ones? What's wrong with the IT systems? What's the challenge? Expound. What's the challenge with IT systems? Okay. So they break down. The what? What's the challenge with the location?
Poor payment.
Poor payment to who? Some of these you are telling lies. Working from the road.
Staff, the lecturer.
I don't agree. I've been here over 20 years. I don't agree. Anyway, the external auditor must understand business risk. Okay, we shall come back to this. Okay, there are more interesting business risks that you should be able to point out. Things like terrorism. That's why we check your bags when you're coming in. You see, terrorism, and these are some of the risks you should be being able to point out. Competition, staffing, terrorism, these are big ones. Yes, limited space, IT systems breaking down. These are business risks that they must understand. Okay? These are risks that they must understand. Okay? Non-payment from the students. You don't want to pay. Non-payment. Okay? These are the risks. Okay, so the auditor must understand the risks that the business faces. Auditor must be very inquisitive. We shall say more about this today. The auditor must be a good listener. The auditor must have an in-depth knowledge of general accepted audit standards. Okay, we are going to be discussing international standards on auditing. This you must understand, and that's going to be our work. Okay, international standards on auditing. The auditor must be a natural skeptic. We shall be discussing professional skepticism today. The auditor must be very skeptic. The auditor must learn his tools of trade and so on and so forth. So make sure you know the qualities of a good external auditor. The examiner may ask you. This examiner is fond of asking all kinds of things. So prepare for that. Not difficult at all. Okay, next we have types of audits. Last sitting, candidates were asked to discuss types of audits. The types of audits, they will ask you. They will pick from this list. Types of audits. Everything here is examinable, including June. In a few days, we shall be studying internal audit. And we discussed last time, internal auditors are different from external auditors. So you should know the difference between an internal audit and an external audit. An internal audit is mainly concerned with compliance with internal controls. That's the main thing with internal audit. Okay, internal auditors. We shall say more about them soon in detail. Internal auditors. These are employees, and they're mainly concerned with compliance. Compliance with what? Compliance with internal controls. Okay, that's their main work. This is different from an external auditor, whose job or role we shall see today is to express an opinion on financial statements where they are free from material statements. You see, the external auditor, he concerns himself with the material misstatements. We shall also understand what's a misstatement. We shall understand what's material. We shall understand what's a misstatement. These are two big terms: materiality and misstatements. Are the financial statements free from material misstatements? So what's a misstatement? We shall see that soon. And then, was there an applicable? The financial statements comply with an applicable financial reporting framework. Okay. And in your case, we are talking about IFRS. Last time I was here, I'm asking questions about P7. I will continue knocking on the door as far as P7 is concerned. So you need to know what's an external audit. Then you will also have financial audits. Some organizations carry out financial audits, whatever the purpose may be. You see, that's different from an external audit. Financial audit may concentrate on some things. Maybe this may be carried out by internal auditors or external auditors. If somebody says the volume is low. How many say the volume is low online?
You're loud and clear. Maybe the gadget is using the one which is bad.
Yeah. In IFRS, have you covered I-36? What is it? Impairment of what? Impairment of? When is an asset impaired? When carrying value exceeds recoverable? And how do you get recoverable amount? Is the higher of value in use and fair value less cost to sell. Now there are some indicators of impairment, not so. Indicators of impairment may be internal or external, not so. So is there a possibility that his low volume is an indicator of impairment? Somebody says we are not getting. What aren't you getting? Please be clear. When you say you are not getting, what aren't you getting? Is it volume? You can't see the screen? Be clear on your request so that we can help you. Increase the volume kindly. Please check your site. From other participants, they are saying the volume is clear. Let's hear from other participants. Is the volume clear?
Yes, it is. It's so clear.
The volume is perfect.
You're one of the many. Please check your site. Check your site. 19 say it's clear. You are 1 out of 20. So there's something wrong with your gadget. Check with it, please. Okay, next, you may ask information technology audit. Okay, information technology audit. This is a type of audit. Okay, we have got a qualification outside there called CISA. Have you heard about it? Have you heard about CISA? What is it in full? Certified Information System Auditors. Okay, so these are people that may be in position to carry out information technology audits. Now, statutory audit, this is what they're going to ask you, statutory audit. This one is mandated by the law, which is different from non-statutory. Okay, this you must be able to differentiate between a statutory and a non-statutory audit. And if you don't understand, please, you ask Google, it will explain more. But it's mandated by law, okay, coming from statute. Okay, then you have a performance audit. Performance audit, this is where the internal auditor is assessing performance of many aspects of the organization, from internal controls and other things. It could also be called an operational audit. Then you could have audits of employee benefit plans, compliance audits. Are you complying? A compliance audit. Payroll audits, you may have a payroll being audited. When you come to level 3, we shall study forensic audits. Okay, where you're examining some illegal activity, some illegal financial activity, forensic audits. This will be more detailed at level 3, not now. Okay, then you could have an audit of operational audits, strategic audits, okay, private audits. You can add to your list private audits, public audits. Okay, the last season we had the examiner asking us for 4 marks the difference between these audits. Please make sure you know them. You see, with an audit exam, everything you leave out, you're in trouble. So you need to know all these things. Okay, next we need to move to limitations of an audit. You see, the audit expresses an opinion whether financial statements are free from material misstatements, but that's why he's using true and fair. Okay, and in a minute today we shall explain what is true and fair in a minute. The auditor never says true and correct when he's expressing his opinion. True and correct, no, he says true and fair. What do this mean? Okay, so why does he say true and fair? Because of the limitations of an external? Because of the limitations of an external audit. And what are these limitations? Okay, this you must know for the examination. Auditing has limitations. First of all, it is a very costly exercise. The auditor is going to be limited by cost. Okay, due to a higher cost burden, the auditor limits the scope of work to selective testing or sampling. That in-depth testing of the books of accounts may not be possible. So 100% may not be possible because of cost. Secondly, an audit is based on test checks, as we shall see, test checking. The sampling and test checking, we shall be looking at sampling in detail. The auditor samples, okay, test checks, which means not 100%. Sampling, okay, the auditor doesn't, okay, this is something we shall be looking at in detail, sampling soon. This is a limitation of an audit, insufficient time. Auditors work with time constraints. Inconclusiveness of evidence. Evidence obtained by an auditor is persuasive rather than conclusive. I told you one of the things we shall be looking at is substantive tests, as I told you last time. And if I wanted to confirm a bank balance, what do I do? Yes. Bank reconciliation and what? Bank reconciliation, we shall be looking at that, which you know how to prepare. You will soon see that I can ask for a bank confirmation letter. Not so. I can ask the bank to confirm. But the bank has told lies. There is a case we have out there where a bank has told lies. It has told the auditor lies. The bank said the client had money when he had nothing. But we're supposed to believe a bank, not so. So audit evidence is persuasive rather than conclusive. That's why we need to do a little bit more work. That's why we shall do a lot of work on the bank reconciliation. And then bank confirmation letter. Then we shall ask for the bank statement. You see, all this is work. All this is audit work, trying to arrive at persuasive. You know, we believe that, okay, if you're saying you have $100,000 in the bank, yeah, probably you have $100,000. Says who? Says the bank reconciliation, says the bank confirmation letter, says the bank statement. Okay, so next, estimates. Okay, there are lots of estimates in the books. Estimates. Management uses lots of estimates. What is IS 8? International Auditing Standard 8. Accounting policies, changes in estimates and errors. So you're using lots of estimates. An example of estimate is depreciation. You see? An example of estimates is your IA-37. Have you covered 37? Provisions, contingent liabilities, contingent assets, have you? Yes? What's the provision under 37? Under IA-37, what's the provision? I'm told you have covered 37. What's the provision under IA-37? Somebody says a liability of uncertain. What's uncertain about the liability? Liability of uncertain what? What's uncertain about it? It has to be a liability. So what's uncertain about it? What's uncertain about the liability? The amount. So we don't know how much we shall pay. What else? Timing. We don't know when we shall pay. When shall we pay? How much shall we pay? We don't know. So there's a lot of uncertainty around the provision. Therefore, there are three items that must be in place for us to recognize the provision under 37. What are they? Three items that must be in place to recognize the provision. Legal obligation. Well tried. Not quite. Yes? Highly probable that you will transfer economic benefits to settle the obligation. Highly probable. What else? That you transfer resources. That's right. Economic benefits to settle the obligation. What else? Yes, so you see, it's a reliable estimate. You should be able to make a reliable estimate of the provision, and then present obligation from the past event. And the past, what is it? The obligating event may be legal or constructive. So you see, a provision is an estimate. Now, auditors are faced with estimates. Estimates in depreciation, estimates in provisions, and in all these cases, the examiner may be telling lies. Rather, what is the management? So we have an auditing standard on estimates that we shall be looking at soon. Okay, auditing standard 540. We shall be studying this soon. So estimates is a limitation of an audit. Okay, because management is using estimates, and then of course the information we are relying on is provided by management, which is outside the control of the auditors. So these are limitations of an audit you should know. Make sure you know the limitations of an audit. Right, so moving on, there's something called the Accountants Act. Do you know the Accountants Act? Have you come across it? One of the laws, pieces of information that guides the accountant in Uganda is the Accountants Act of 2013. Have you come across it? If you didn't know about it, now you must know about it, because it is part of the examination. Okay. Now you don't need to read the whole thing, but there are some things that you need to know. The Accountants Act 2013. This is a must know for your examination. Now the act is here in the box. It's already in the LMS here for you. This is a law. Okay, this is a law, so there's not much to debate about it. You just have to know what is in here. The institute, you know, the functions of the institute, membership of the institute, meetings of the institute, especially the institute. You need to know about the institute and then the council. You know, you need to know about the council. I think that is the main thing you have to know about the council. And then most especially the regulation of the accountant and the practice profession. Okay, so make sure you know something about the institute here. This part 2. What is the institute all about? What does it do? The institute that sets you exam and membership of the institute. Okay, you make sure you know something about part 2, and then you know something about part 6 here. What is it? Part 7. Part 7. Regulation of the accountant, enrollment of a member, disqualification from enrollment, registration as a practicing accountant, getting a certificate of practice, you know, these licenses, how the institute inspects accounting firms. Okay, so part 2 and part 6, I think I must know. You see, we can't spend a lot of time here because maybe they examine, maybe they don't examine it. Part 2 and part 6. Okay, this is a law. This is a law. Accountants Act is the law governing you as the accountant. So please make reference to it. We are supposed to know something about it in the exam. Part 2, it's 37 pages. I don't think you have to read all of it. If you have enough time, you can go through the whole document. If you don't have time, pay regard to part 2 and part 6. This one, part 7. Okay? Members, regulation of the accountant. Okay, so that's the Accountants Act 2013. It's here in the LMS. Make sure you know about it. Take some time and look through it. Okay, we don't have time to, after all, it may not show up in the exam. Chances of showing up 1%. Okay, but don't leave it out in your preparation, and then you start saying the act was there and you didn't know where to find it. The act is here, it's in the box. Look at part 2 and part 7, you should be fine. Okay, moving on, we also have the Companies Act. We also have the Companies Act, and there are some things that you expected to know as far as the Companies Act is concerned. There are things that I expect you to know out of the Companies Act, very specific. Companies Act, you have done some of the law. So we have the Companies Act of 2012. What do we have to know in there? You don't have to know the whole document because much of it has been covered during your law classes. But there are some things that relate to the auditor that we need to know. Okay, so the act is all here. You don't need to read all of it for purposes of the audit exam, but for the audit exam, this is what we need to know. So So sections 166 up to 170. That is all you need to know. 166 up to 170. These sections you must know in the Companies Act. What are they about? Okay, these sections are about how the auditor is appointed, appointment of the auditor, his rights, his removal from office, stroke resignation, how does he resign, and then how is paid, remuneration. 166 to 170 is for your examination. How is the auditor appointed? Remember, this is the law. Okay, 166. So the act is here. 166. The auditor has a right to receive copies of the balance sheet and auditor's report. So what are his rights? Appointment and his remuneration, 167. Okay, so if you're talking of the rights are in 166. 167 is appointment and his remuneration. 168 is removal. How is he removed from office? 169 disqualifications for appointment as the auditor, so you cannot act as an auditor if you are disqualified. And then 170, the right, access to books and to attend the meeting. So you need to know the rights. This they are going to ask you. So sections 166 to 170, you must know for the examination. And where is the act? The act is here in the LMS. So you read sections 166 and 167. This is the law. You just have to know the law. Okay, they are not asking for your suggestions in case the exam shows up. Nobody is going to ask you, please suggest. No, they are not going to ask you to suggest. They are going to just ask you to state the auditor's rights. They are going to ask you how is the auditor appointed according to the law? How is he removed according to the law? Okay, this is what they are going to ask you. Okay, section 164 here. So 164 is here. Directors, what is it? 166. Right to receive copies of balance sheet and auditor's report. So you read what the right is here. The rights are there. Appointment, how is the auditor appointed? Appointed and remuneration, how is he appointed? Appointed at the AGM, appointed by who? Shareholders. So you read about his appointment. And how is paid here? 167. How is he paid? Then how is he removed from office? 168. How is he removed? The law is here. How the auditor has got to be removed from office? 168. And then 169. Who is disqualified to act as an auditor? A person or firm shall not be qualified for appointment as an auditor unless he or she, in the case of a firm, every partner in the firm is a member of, you must be a member of professional bodies, Institute of Certified Public Accountants of Uganda. None of the following persons shall be qualified for appointment as an auditor of a company, an officer or servant of a company. So you can't be an officer in a company and then you're an external auditor. A person in employment of the company, a body corporate, and so on and so forth. So the people who are not supposed to act as auditors are in section 169. And then lastly, 170, more rights. The auditor's right. Okay, to books. He has got a right to books of accounts and to attend the general meetings. Okay, so this you must know in sections 161, 166 to 170. Okay, appointment, rights, removal, resignation, remuneration. Okay, 166 to 170. That is the Companies Act. Those are the only sections you should know as far as the Companies Act is concerned. So make sure you know them. The exam is going to ask for one of them. I don't know which one. Okay, I don't know which one. They can't ask for all. They will ask for one of them. Just one of them. That's why you see we can't waste a lot of time here, because again it may not show up, but you need to prepare for it. So you must prepare in case they ask us about the act. Okay, the rest we shall come back. We shall come back to the others. We shall come back to the others. Right, so we have something here that we shall be calling the Green Book for purposes of our classes. So we have 3 references. We have the LMS notes, we have the Green Book, and then we have the guidelines, the Green Book, and then you have your past papers. You have your past papers. So these are going to be your resources as far as so this is your Green Book. Okay, now what's about this Green Book here? It's called a practice and revision kit. So why do we call it a practice and revision kit? Why is it important? So you have the LMS notes that are going to help us. We have the Green Book, questions and answers, and then we have the guidelines how to use the Green Book, and then we have the past papers. Okay, these past papers you have. So let me say something about the Green Book, because this Green Book is going to be our reference point throughout the semester between now and the examination. So what is the Green Book all about? This Green Book has got 106 questions and answers, and it has got 3 mocks. Okay, and each mock has got 5 questions, so which means there are 15 questions in the mocks, and then we have 106 questions here with questions and answers. That is the Green Book. How does the Green Book look like? It is here. It's already in your LMS. Okay, if you look critically in the LMS in the first lecture, it is seated at the bottom. Okay, it is seated at the bottom. It has got 106 questions. Now, how do we use it? Okay, the 106 questions, how do we make reference to these questions in this Green Book here? Now, this is how we use it. This is how we use it. Yes, I'm moving pictures, and the pictures will soon make sense to you. I hope you use the pictures, okay? So these are the guidelines to using the Green Book. Okay, these are the guidelines that, okay, so this is already in the LMS. I said it has got 106 questions with questions and answers and 3 mocks at the back. Now, when you're using the Green Book, these are the topics that have to be covered in the Green Book. Okay, they are very particular. Now, before you go for the examination, you need to tick off that you know each and everything on this list here. Each and everything on the list, you must know. What's in red are the questions. What you have in red on this list are the questions. For example, if I want to know what's an external audit, something that we have already covered, I make reference to question 8 and question 21. So I come to the Green Book here, and I go to question 8. Okay, let me move my pictures here. Okay, because they say I'm moving pictures, so let me move the pictures. Yeah, the pictures are moving. and we'll be moving for a long time. So question 8 here helps you to understand what's an external audit. What's an external audit here? Okay, if I go to question 8, this question is about understanding what's an external audit, something that we've already covered. Draft an explanation detailing with the purpose of an external audit and its role in the audit of large companies for inclusion in your firm's training materials. So this is the question. If I also move to question 21, okay, because it's on the list as explaining what's an external audit. So if I move to question 21, probably I will find something here in 21 here, 21A. State the objective of a statutory audit and explain how carrying out an audit in accordance with auditing standards helps an auditor to achieve that objective. Okay, very soon we shall be understanding what are auditing standards. So you move to this list here, external audit, and you make reference to question 8 and 21. Okay, so some of the things you have already covered, and much of them will make sense by the end of today. So this is the purpose of this list. It has got everything that we need as far as the examination is concerned. Everything, okay, that we are going to cover in the days that follow on this list, which is now in the LMS. It's already there. So we are going to cover things like what's an external audit, what are auditing standards, what's the role of your Institute of Certified Public Accountants of Uganda, what does it do? Agency and stewardship, this I finished last time. Okay, we shall get to know what's insurance, ethics. We have already done something on independence. And the other things we shall get to know as we move along. Okay, we shall get to know them as we move along. So this list is going to help us to understand what we need to cover as far as the examination is concerned. Until we are done with what is on this list, then we cannot say we are ready for, we're not ready for the examination. Okay, we're not ready for the examination. So now the next thing is to understand what are auditing standards. What are these international standards on auditing? Before we dive into the matter. And who sets them? Okay, international standards on auditing and who sets them? Now you come to the list here and you look at questions 1, 2, 3, 7, and 9. 1, 2, 3, 7, and 9. So if I go to the green book, I need to make use of questions 1, 2, 3, 7, and 9 to help me understand what are auditing standards and who sets them. So when I come to the book here, question number 1 in the book, question number 1 in the book is asking me, what are these auditing standards and who sets them? Okay, so question 1 is here. So the question is, explain how international standards on auditing are developed by the International Accounting, by the International Auditing and Assurance Standards Board. So how are these standards developed by the board? And then explain the role of professional bodies in the regulation of auditors. So what is the role of your institute in as far as the regulation is concerned? So this is question 1. Now you move to the back and you find the answers there. So that was question 1. So when I move to the back of this manual, I'll find the answers to question number 1 here. So the development of standards, how are standards developed? This is the answer to question 1. So it's at the back. So development of standards. You now come here and find out the role of the International Accounting. What is it? International Auditing and Assurance Standards Board. They will ask you in the exam. What is the role of this board? And what's its role in as far as developing these auditing standards is concerned? And then what are these auditing standards? So these are standards set by the International Auditing and Assurance Standards Board, which is a technical standard committee of IFAC, and the board is made up of representatives and so on. Standards are developed in consultation with interested parties within the profession and outside. So you need to know how standards are set. And then part B of the question was, what is the role of the professional bodies in the regulation of auditors? Now, one of the bodies is your Institute Certified Public Accountants of Uganda. So you should know what is their role. Okay, so that is question 1. Now moving on to question 2. So in your time, you'll refer to question 1 and the answer. So you need to start ticking off those questions. So we shall go through all these questions in the course of the classroom. So question 2, so that was standards. Okay, standards. Who sets the standards and what's the role of it? Now question 2, explain why it's important for audits to be conducted in accordance with auditing standards that are common to all audits. So why is it important that an audit should be conducted in accordance with auditing standards? So the exam will ask you, why is it important that an audit is conducted in accordance with standards? So question number 1 covered what are standards and who sets them. It also covered the role of your ICPAO in the regulation of auditors. Okay, Institute of Certified Public Accountants of Uganda in regulating auditors. What is the role of ICPAO in regulating auditors? So this is question number 1. Now you come to question number 2. Why should audits be conducted in accordance with standards? You have the answer. And you can see the marks. In the exam, they will ask you 3 marks. The answer is at the back. Now you come to part B. Last time I explained independence and I explained the threats to independence. What are they? What are the threats to independence? Self-interest, self-review, intimidation, advocacy, and then familiarity. Now you need to start answering questions here. You need to start answering these questions here. So you can see in part B, what is meant by advocacy, threat, and give an example. You have the answer at the back. State the category of threat that arises from an appropriately close business relationship with the client. What threat is that? Familiarity, and then give examples. The answer is at the back. So you can see if you come to the list of pictures here. Question number 6, if you look at area number 6, ethics and independence. To start practicing your ethics and independence, you're going to make reference to all these questions. If you are comfortable with independence, if you're comfortable with threats to independence, you start practicing question 2, 5, 12, 13, 14, 15, 69, 72, 89, 93 part B. Then you go to the mocks at the back. Mock 2 question 3 and mock 3 question 4. So these questions will prepare you for independence as far as the exam is concerned, and we shall begin to review them. So you can see question 2 is already on the radar. The question is at the back. Okay, I will come back to what we mean by review engagement. You can leave that out for the time being. Now you come to question 3. We have already covered accountability, stewardship, and agency last time. When I was here, we covered accountability, stewardship, and agency. Okay, and then here they're asking you about review engagement audit. We shall come back to that. But you should now be able to explain the relationship between standards on auditing set by the board and national standards applying to auditing. Okay, these questions you should be able to answer. So when you come to the list, answer all the questions that concern standards and the board. All these questions. Then you should be able to understand the role of Institute of Certified Public Accountants of Auditors in regulating the audit. You answer question 1. Okay, so agency and stewardship is question number 3. And when you come here, you can see that is question number 3. It is covered here. You should explain accountability, stewardship, and agency. So what this list does is to ensure that you are covering, you are moving, you are ticking off whatever you know. You're not reading what you like. Okay, you have to move with focus. So this we have already covered: external audit, auditing standards, the role of the institute, agency, assurance. I will come back. Independence, you should start tackling some of the questions, and I will keep coming back to ethics and independence later on. Okay, then the others will fall into place. Okay, so that is how we are going to use the green book and the list. The green book. Don't get the book and run with it without the list, because it's not a case of reading anywhere. Okay, you have to read systematically. You don't get the green book and then you read what you like. No, you come to this list and you tick off that you understand each and everything. Okay, so this morning I was reading about confidentiality between the auditor and the client. So which numbers am I attempting? Question 5 and then mock 1, question 4. Those 2 questions will cover your confidentiality, because for some of these things There are no notes. So who is this one talking? We did not cover anything to do with agency. Where have you been? Yeah? If you're just showing up for the class on day one, please wake up. We covered this last time in class. Please go to the LMS before you start making comments like, when did we cover this? Go to the LMS and see what is there. And make reference to the previous recordings. Okay? Before you start making sweeping statements like, when did we cover this and when was it done? Nothing is discussed here that hasn't been done. Sorry. Okay? So let's move on. Now, there are some people who believe that these classes flow with them. When you wake up and you remember there is a class, you also believe, okay, that's where things should be. Always check what is in the LMS and check the recordings, okay? Before you start making sweeping statements here, when did we cover agency and all this stuff? Where were you in the last lecture? Okay, I will check whether you attended the last lecture. Fine. So let's. So that's what this list is all about. Okay, that's what this list is all about. So you need to make use of the green book while making use of the list. Okay, that means that your reading must definitely follow what is here. Okay, it must follow what is here. Okay, now in the box, I will put the box later, but now we need to look at what is in standard. We have got auditing standard 210. Okay, that is agreeing the terms of the engagement. Okay, so now we know what auditing standards are, and make use of those questions make use of these questions on the list. Okay, make sure you try out the questions under part 2 and the questions under part 3. Those ones I must do. Okay, and then agency stewardship, make use of the notes, and you have got the question here and the answer. If you still don't understand the answer, you can ask, but the question is there. Question number 3, the answer is at the back. So let's now move to auditing standard 210, agreeing terms of engagement. Yes. Yeah, okay. But they always block me. How come you never come to? Huh? You never come to look for them. I think that person should wait. Okay, fine. So let's look at what's in. Let's look at what's in 2010. Now, some of the items to be answered in 2010 are preconditions. Preconditions for an audit. An engagement letter. And then steps before. Steps before you accept an audit. Steps before you accept an audit. Now, preconditions for an audit. Before an audit can take place, there must be preconditions. And this is what is in 2010. Our first auditing standard that we are covering now is 2010. Agreeing the terms of an engagement. Okay? I will first cover 2010, then I'll come back to 200. So now, what are preconditions for an audit? Now, as far as I'm concerned, I can either make use of what's in the LMS, or I can come to the list here. The question is, what is preconditions for an audit? Preconditions for an audit, I will find them in question 29. So what do? I come to my green book here and go to question 29. What does question 29 say? It will help me understand what are preconditions of an audit. So I come 29 here. And if you look at part A of the question, they are saying, describe the process the auditor should undertake to assess whether preconditions for an audit are present. So these conditions must be there before we can talk about an audit. Now for 3 marks, question 29, I will move to the back of question 29 and answer the question, what are preconditions for an audit? Now, if these preconditions are not there, then we cannot even start talking about an audit. Okay, so I come 29 at the back, the answers are attached. Okay, 29. Now here is the answer to 29. Okay, this is question 29. And here is the answer. So preconditions for an audit, they're here. Okay, so can you review this answer as I unblock these people so that we continue the discussion on preconditions of an audit? So the three items we are trying to address are preconditions of an audit, what's an engagement letter, and then the steps that you take before you accept as an auditor, as an external auditor. What steps you consider before you accept an audit? So preconditions for an audit, question 29. And where's question 29? Question 29 is there. Preconditions for an audit. What are they? Because if these are not in place, then you cannot start talking about an audit taking place. So the examination will ask you for the preconditions for an audit. So what are the preconditions for an audit? So the first thing before an audit takes place is that there must be an acceptable financial reporting framework. Okay, so that's the first thing as far as preconditions for an audit are concerned. The preconditions: one, an applicable financial reporting framework. Because an audit cannot take place, you prepare the financial statements in accordance with what framework? You see, that's what I was telling you last time, that IFRS. That must be in place. There must be an applicable financial reporting framework. And then agreement of management, and where appropriate, those charged with governance, the premise on which an audit is concerned. And what are these? First, determine whether a financial reporting framework is acceptable. So if I show up, I would expect that you're using IFRS or IPSAS. That's an acceptable reporting framework. If you're using something else, then we may not be able to audit your financials because we don't know what framework you used. Secondly, management's agreement that it acknowledges and understands its responsibilities for the following. Management must acknowledge and understand its responsibilities for the following. One, that their responsibilities prepare financial statements in accordance with an applicable financial reporting framework. IFRS, IPSAS or something, local GAAP or something. So the reporting framework must be acceptable. Secondly, they must accept their responsibility for internal controls necessary for the preparation of financial statements, which are free from material misstatement. That's their responsibility. And then thirdly, they should give the auditor access to all information That's the responsibility, to accept the auditor unrestricted access to information. So the examination is going to ask you to discuss these preconditions for an audit. And you can see is something which is going to be in the range of 3 marks. So that you must know. If these are not in place, applicable reporting framework, and then management acknowledging responsibilities, then the audit cannot even take place in the first place. So preconditions for an audit, this you must know. Okay, this you must know for the exam. Preconditions for an audit, and please find it in question 29 on the list. Now moving on, the next thing we should know is steps before accepting an audit engagement. The exam is going to ask you, what must be in place before an audit accepts an audit engagement? Okay, what must be in place? Now you go to question 14C. Question 14C, of course, I will go direct to the answer, but you can always read the question. So the question is about what steps should the auditor follow before he accepts an audit engagement. So your answer is in 14C, and these are the steps. So 14 here, and I moved 14C. So here, steps prior to accepting an audit engagement. So these are the procedures that must be followed. So you come to your list here, and you tick off that you know the steps before accepting an audit engagement in 14C. This is the purpose of these guidelines here. So what are the steps that the auditor follows before accepting an audit engagement? Ensure that there are no independence or other ethical problems likely to cause conflict with the CPA code and other applicable ethical guidelines. So independence is important. Are you independent? 2, ensure your firm is professionally qualified to act, considering whether the firm may be disqualified on legal ethical grounds. Now we have been seeing the Accountants Act, and we have also been seeing the Companies Act. Are you professionally qualified? Okay, are you professionally qualified? Now, when you go to the other section, Section 169 of the Act, you will see who is disqualified from acting as an auditor. 3, the firm's existing resources, are they adequate? Do you have the staff? Do you have the time? Do you have the technical expertise? 4, you need to communicate with the present auditors. Of course, to communicate with them, you must obtain permission from the client, okay, to whether there are circumstances behind the change which the new auditor ought to know. So it is important that you communicate with the outgoing auditor. And then lastly, consider the response from the existing auditor for any issues that may impact on your acceptance decision. Okay? Now, the other steps that you may have to take include undertake client screening procedures. You need to screen the client, looking at management integrity, assessing whether there is any conflict of interest with existing clients and otherwise. This is something that you must do also. You need to carry out other screening procedures, such as assessing the level of audit risk of the client, whether the expected engagement fee is sufficient for the level of risk, the money they are going to pay you. Are the fees sufficient? Assessing risk. Okay, so these steps you must know in question 14C here. The question will ask you steps prior to accepting an audit engagement. So you come here, you say 14C, I'm ready for the examination because I know 14C. Okay, 14C here. Steps before accepting an audit engagement. Now you come to the next. Now, before the engagement starts, you need to sign an engagement letter with the auditor. An engagement letter is the contract between the auditor and the client. So where is it covered? It is covered in all these numbers. Okay, question 37B. So 37B is engagement letter. 69D and 103A. 69 and then 103. So I move to my book here, the green book. And I look at questions 37. So what does question 37 say? So engagement letter is the contract between the auditor and the client. So question 37. 37 is here. So auditing standard 2010, agreeing terms with audit engagement. State the purpose of an engagement letter. What is the purpose of an engagement letter? 1 mark. And then 6 matters that would be included within an engagement letter. So this is covered in question number 37B. So I go to 37B here. So question 37B, and I deal with the engagement letter. So this is your question 37, and part B, I'm asked what's an engagement letter. So here you have the definition of an engagement letter. Okay, contract between the auditor and the client. So 1 mark, you explain what's an engagement letter. Then part B, they were asking for matters to be included in engagement letter, at least 6. Objective of an audit, scope of an audit, management auditor's responsibility, management responsibilities, identification of applicable reporting framework for the financial statements, which is probably IFRS, and so on and so forth. So the exam was asking for 6, but you have got a long list here, including fees, using experts, using internal auditors, liability, arrangements with the predecessor auditor. There are so many things that can be in an engagement letter, so many. And most of them will become apparent at the end of the course. So you should know what's an engagement letter, and then what we put an engagement letter. Now you also move to question 69 and see what is there. So you see your revision has already started. Okay, so you start using this green book tonight. So you move to 69 here, and they're asking you about an engagement letter in 69. What are they asking? During your preliminary audit planning, you know that the engagement letter has been returned and signed by the directors of mystery. So these people don't want to sign the engagement letter. Remember, this is a contract. An engagement letter is a contract between the external auditor and client. Now, these people have not signed it. When asked to explain the action, the directors indicate that they cannot allow you access to information on the company's new website development, as this contains vital trade secrets. So they don't want you to access their trade secrets. You are therefore unable to perform audit procedures on research and development incurred on the website and included non-current assets. Now they want you to explain your actions as a result of the directors not signing an engagement letter. So the directors don't want you to sign don't want to sign an engagement letter, don't want to sign the contract. What do you do? What do you do? The answer is in 69D. So you go to the back of the book and you look at question 69. You also go to question 103 and you deal with what is there in the engagement letter. Now, when you come to, because some people like notes, so we need to cater for everybody. Somebody was asking, I've never seen an agency. So some will say, no, engagement letter we have never covered. That one we have never heard about. Preconditions for an audit, when was that one covered? We have been around for a long time and we hear and see so many things. Engagement letter, was that one taught? Engagement letter, who taught that one? When was it taught? So you now come to your class notes here for purposes of those. And you look at you have got 2 documents here that will help you cover standard. We are covering standard 2010. Okay, so we have 2 documents here to help us cover standard 2010, but I've already covered what's in there. So this is up to you, whether you are interested in the questions or you are interested in 2010. So this is all in the box. Okay, so for those that we have got enough information here to help us cover standard 2010, but this is what we need to know. I've already covered the main issues in standard 2010, and as you can see here, now you don't really need to go to explanatory material in these standards. What you need to cover is the first 20 pages here. Preconditions for an audit, have we covered that? Yes? Question 29. You see, I like to move quickly with the examination. Question 29 covers preconditions for an audit. But in case you are in doubt, you can still move to the LMS and you'll find a document which is explaining preconditions for. Then what's an engagement letter? Okay, and then in case circumstances change during an audit, you may have to give a revised engagement letter. So this is, so you just need to cover what is between page 6 and 21. That's enough, but we have covered all that we need to know for the exam. Okay, preconditions for an audit, engagement letter, steps before you accept an engagement. Look at question 37, 69, 103, and then when you are done, you can make use of these two documents, which are in the LMS. Standard 2010, agreeing the terms of audit engagement, or you can use that one. They will all take you, they will all deliver the same thing. Make use of what makes sense to you. It's all there in the box. Preconditions for an audit, engagement letter, recurring audits, and then if there is a change in the circumstances, okay, you may have to give a revised engagement letter. That's what they may ask you, okay, on page 13. Okay, for recurring audits, you may not have to give, so you see here, it's contents. So for recurring audits, the auditor shall assess whether circumstances require the terms of the audit engagement, to be revised, or whether there is a need to remind the entity of the existing terms of audit engagement. Now, acceptance of a change in the terms of audit engagement. Now, the terms of audit engagement may change. When they change, these are the procedures you follow. The auditor shall not agree to a change in terms of engagement when there's no reasonable, justifiable justification for doing so. If prior to completing audit engagement, the auditor is required to change the audit engagement, to an engagement that conveys a level of assurance, the auditor shall determine whether it is reasonable justification for doing so. Now, if you don't agree, some of the things may be to withdraw from the engagement and so on. So please make use of this section here, and you know the terms when the audit letter may be amended. So make use of preconditions for an audit, engagement letter, recurring audits, and then when the terms may be changed. Okay, that is what you need to know in Auditing Standard 2010. This is already in the LMS. Okay, so I will be using what's in the LMS, and I will be using the green book. But my preference is on the green book. But this is for people that like notes. Plenty of them. They are here for you. Okay? Don't go disturbing the college for notes. They are all in the LMS. So if you are looking at 2010, Auditing Standard 2010 is covered in the LMS, agreeing the terms of engagement. For me, I'm interested in these questions. Preconditions for an audit, 37, 69, 103 engagement letter, and then 14C for steps before you accept an engagement. Okay, now let's move on. Now, next is Auditing Standard 200. Auditing Standard 200, very straightforward. There are some things that we need to know there, very specific. In Auditing Standard 200, there are some very particular items that we need to be able to cover in there. So what do we need to know in Auditing Standard 200? Very specific items. So Auditing Standard 200 should be seen as the starting point in developing an understanding of auditing standards. It contains the basic objective and requirements that should be followed in all audits of historic information. Now, what do we need to know? Now, the key elements of an auditing Standard 200 are here in red. First of all, you should be able to understand, as this was examined even last sitting in June, the objectives of an external audit. What are the okay? What are the objectives of an auditor?
Share the screen.
Okay, what are the objectives of an auditor? Objectives that clearly state the overall objectives of auditor. Then definitions that clarify key terms relevant to auditing. and then the requirements that are set out in the conduct of an audit. This is what you should know in standard 200. Okay, so what are the objectives of an audit? Right, so we are looking at auditing standard 200. And the first thing is the objectives of the audit that you must know, and then the separate requirements that are required in the standard. So first we looked at the objectives of the auditor. The next, specific requirements, ethical requirements we have covered, independence, professional skepticism we are going to see, including professional judgment, sufficient audit evidence and risk, things we shall be studying soon. And then the next thing that is covered in here is the conduct of an audit in accordance with standards. So the third element is conduct of an audit in accordance with auditing standards. So these are the three elements to cover in this particular standard for your exam, particularly here, objectives of an audit. Okay. So conduct of an audit. So these are elements that the auditor should follow. Okay, so the auditor should comply with all auditing standards relevant to the audit. He must understand the entire text of these standards and the explanatory paragraphs in there. The auditor shall not present compliance with the standards in the audit report unless the auditor has complied with the requirements of all auditing standards and all other standards relevant to the audit. To achieve the overall objective of the auditor shall use the objectives stated in the relevant standards in planning and approving his audit. So you can see number 5, the auditor shall comply with each requirement of auditing standards unless in circumstances of the audit they are not relevant, and so on and so forth. The final requirement deals with the failure to achieve an objective. Okay, so these 6 elements you must know for the exam. Okay, so conduct of an audit, really this is about applying auditing standards. Okay, applying auditing standards, and then specific requirements, but most especially objectives of an audit. This is highly examinable. Now, of the separate elements, 2 are most important here for examination purposes. 2 are very important. Professional skepticism and professional judgment. That's examination material. Okay, that is examination material. That one we have got to prepare for it. So if you move to our list here, point number 17, professional skepticism and professional judgment is found in question number. So I come to the green book. And see what they're asking me in question 35. What are they asking me? $35 here. You can see in part A, they're asking you explain what is meant by professional and why is it so important that the auditor maintains professional skepticism throughout the audit. So they're asking explain. First of all, explain why it is. And why should the auditor maintain professional skepticism throughout? 3 marks. You see, I'm not a person that likes a lot of notes here. I'm not so much interested in what is written in the standard. I'm very much interested in what examination question will show up. And this is how the exam question shows up. Part 2, define professional and describe 2 areas where professional judgment is applied when planning the audit of financial statements. Question 35. Okay, question 35. So when we're talking about professional skepticism and professional judgment, you come to question number 35 in the green book. I told you, you'll have to deal with the entire green book before the exam, before we are done. So now we go to question number 35 and see what are they asking there. because the objectives for, what is it? Objectives of an audit. This was examined, I told you, last June 23. Candidates were asked to explain the objectives of an audit in auditing standard 200. This was in June 23 for about 3-4 marks. You had to list those objectives. But more especially, they are going to ask you about skepticism and professional. What is it? So you come to 35. Question 35. And we'll look at the answer in question 35. Skepticism versus judgment. What is skepticism and what is judgment? So question 35 is here. That's 34 and then 35. So what do we mean by professional skepticism here? Is an attitude that includes having a questioning mind, being alert to conditions which may indicate possible misstatement, fraud or error, subjecting audit evidence to critical assessment rather than just taking it at face value. I told you last time. You ask the CEO, how many employees do you have? He says 200. Head of human resources says 300. So there's a problem there. How many cars do you have? Maybe 6, maybe 10. It's important for professional skepticism is maintained throughout for an audit to reduce risks of material misstatements. So you have to maintain skepticism throughout the audit. It is necessary for the critical assessment of audit evidence. So this includes questioning contradictory audit evidence, reliability of documents, responses from management and those charged with governance. How many bank accounts do you have? 10. When you ask the CFO, there are 4. So the CEO thinks 10, and the CFO says there are 4. So what has the CEO been signing if he thinks there are 10? And the CFO thinks there are 4? That is contradictory audit evidence. You see, reliability of documents. I have a friend that used to work in PwC many years ago. So he told me he went to audit a firm in town of some Indians, and then they gave him the cash book. Midway the audit, they told him they had given him the wrong cash book. They had given him the cash book for URA. This was not the cash book for auditors. There's also a cash book for shareholders. So there's a cash book depending for who. So reliability of documents. You must maintain skepticism throughout. Then the next element is judgment. What we mean by judgment? And where does the auditor apply judgment? You see, from your training, your experience, your knowledge, you apply judgment to make informed decisions. Judgment when planning the audit, judgment in materiality, judgment in misstatements, judgment in procedures to use, judgment in everything. The auditor is using judgment throughout. So those 2 elements, you should be able to explain in question number 30. Number 35. Okay? So you use the list here. And you tick off before you go for the exam that I know professional skepticism and judgment. That is the purpose of this list. Okay? It avoids reading what you like. You tick off that I know what I mean by true and fair. That's the purpose of the list. Okay, that's the purpose of the pictures here. Okay, that's the purpose of these pictures. Do I know the steps before accepting an audit? Do I know preconditions for an audit? Do I know the engagement letter? That's the purpose of these pictures here. Okay, somebody called them pictures, so we shall call them pictures. So make use of these pictures before you go for the examination. Okay, now let's continue. Now there's something called confidentiality. Confidentiality must be maintained between the external auditor must. The external auditor comes across so many things. Then when he's drunk in the bar, he starts letting the cat out of the bag. You know, the CEO of that company is paid so many millions. How much? Yeah. After 2 beers, he lets the secrets out. Confidentiality. This is something which is in the engagement letter. Okay, engagement letter. One of the clauses there is about confidentiality. You don't go talking about things. Now, if I was preparing for confidentiality in the examination, where do I look? I come to my list and I look at questions 5 and mock 1 question 4. So what does question 5 say? You see, some of the things I use LMS, some of the things I use the green book, because I have a journey to make and I should start moving. So I come to question 5 here. Do I know what is confidentiality? So question 5 says that list and briefly explain the main threats to independence. And for each threat, give an example. Do you know the threats? Can you give an example of each? Because if you don't know them, you are an endangered species. You should be able to give an example of each threat. If you don't know, go to question 5. This we have covered. But somebody will ask, when did we cover the threats to independence? When? Which class was that? So part B, briefly explain the fundamental principle of confidentiality and list the circumstances in which obligatory and voluntary disclosure of information may be applicable. There are times when you're obliged, it's an obligation by the external entity, you need to release information. But there are times when the information you're going to release to authorities is voluntary. You must be able to explain the concept of confidentiality. Question number 5. Question number 5 here. Okay. Then I go to mock 1 question 4. So where are the mocks? Because I'm talking about mocks, mock this, mock that. So I go to the mocks at the back. The mocks at the back. After the 106 questions, you will find the mocks. So first in mock 1, and then in mock 1 we have question 4 there. So which mock is this? This is mock 2. So I move up and I'll be able to find mock 1. So this is mock 1 here. These are the mocks at the back after the 106 question. So this is mock 1. And I'm being told to go to mock 1 question 4. That's where confidentiality is. Mock 1 question. So for here, this is question 4. Mock 1 question 4. Look at part C. Explain the auditor's ethical responsibilities with regard to client confidentiality and when they have an obligatory responsibility and voluntary responsibility to close information. So you must be able to explain 2 elements. Obligatory and voluntary. That's examination. Obligatory disclosures and then voluntary disclosures. Which questions? Question 5 and then 1 question, mock 1 question 4. You find the answer there. These are your notes. Now, when you read these 2 numbers, you don't have to go back to the textbook to start making notes on confidentiality. Wasted energy. If you want to summarize what's in the green book. Okay? You don't have to go to any textbook and start looking for what's confidentiality. Unless, of course, you're writing a thesis on confidentiality, not so. Yeah? University thesis on confidentiality, you're allowed to probe the world, not so. Yeah. So this covers what we mean by confidentiality. Okay? And if you move to, of course, the answers to the mocks are here. So if I move to the bottom here and I go to question 4, mock 1. What was it? Question 4. Okay. Mock 1, question 4. So this is question 4 here. And then I look at the last bit of the question here, confidentiality. Due to confidentiality requirements set out in the CPA code, members have an obligation to refrain from disclosing information acquired in the course of professional work unless their client gives them permission to do so. Confidentiality is an implied term of auditors' contracts with their clients. Implied terms, you have covered them in company law, implied terms. And this obligation continues even after the professional relationship between the auditor and client has ended. Even when you cease to be the auditor, you don't talk. However, there are some exceptions. There are some exceptions to the rule. And what exceptions are these? Obligatory and that's the examination. So make sure you know that. You read question 5 because question 5 is the same as mock 1 question 4. The answers are the same. Is that clear? That's confidentiality done. Okay, that's confidentiality done. So you come here and you tick and you say, I know confidentiality before the examination. Is that clear? Before you go for the exam, you start saying, I know confidentiality. Not going there and then you say, I was outspotted. They didn't bring my paper. Which was your paper? My paper was Independence. You say I was reading Independence, they brought confidentiality. No, you read according to the list. Okay, it is now 4 o'clock. We take a break. And when we return, I will discuss conflict of interest. Conflict of interest. So what is the time now? Break for how long? So we resume at 4. When is the next lecture? Yeah, but what time? I'm just checking. Yeah, because some people will say we never covered the stewardship and all these things, you know. They will say, no, the lecture never took place. The lecture has never taken place. So please be reminded, we have a lecture at 6. The lecture at 6 compensates for which day?
23rd.
20?
23rd.
24th. Is it 24th? 24th is a Sunday.
24th.
Yeah, Sunday. So the lecture today at 6 compensates for the lecture on Sunday, 24th. But we have a lecture on 19th, don't we? Don't we have a lecture on Tuesday? Anyway, let's come back from the break. Let's take a break. Okay, let's now deal with the. Let me deal with something called conflict of interest. Now, there are two conflicts that the auditor should deal with and learn how to resolve. One, being in the same business, your clients, and then having two competing clients. So let's say you are the auditor of company A, and this company is in this company runs a hotel business, and then 40 kilometers down the road, the external auditor also runs a business B, which is a hotel business. So you are the external auditor here. So you are advising the hotel about competition. Who is the competition? You are the external auditor of hotel A, and you are advising them about competition. Who is the competition? Yeah, you are 40 kilometers down the road and you are advising the client about competition. This is clear conflict of interest. This is something that you must avoid. This is the first one. This is the first scenario, and we're going to see how to avoid this. But this is what the exam will ask you. Now, the second situation is that you have got client A here, the bottlers of Pepsi Cola products in Uganda, and then you have client B here. They are the bottlers of Coca-Cola products in Uganda. Can they have the same external auditor? Can they? Can they be audited by the same external auditor? Pepsi Cola products here and Coca-Cola, same auditor here? Is it possible? UBL and Nile Breweries, these subsidiaries, can they have the same external auditor? Yes? Most likely not. Okay, so how do we go about this issue, conflict of interest? Being in business with your clients and then competing clients, auditing competing clients. How do you resolve this? The answer is in question 12 and 80. Okay, so if I go to question 80, in question 80, we have two hotels. Okay, and I'm already here. This is question 80 here. And what the question is asking, if you look at the question in the green book, question 80, is we have two hotels. Okay, or two Pepsi Cola and what is it? And Coca-Cola or Nile Breweries and Uganda Breweries. These are people in the same business. So the code states that on the face of it, there's nothing improper in having two or more clients whose interests may be in conflict, provided that the work that the firm undertakes is not itself likely to be a subject of dispute. Now, how do you manage this? You need to manage the interests of one client, you need to ensure that the interests of one client do not affect adversely those of the others. And you need to put some, as the auditors, you need to put some safeguards in place. Okay. Now, first of all, you need to notify the two companies that you're auditing them. In case you have two competing clients, they must all know that you're auditing them, and you must get their consent to continue to audit them. See? And in case they refuse, of course, you need to make a business decision. Who is more profitable, whether you're going to get more business from the other, whatever decision. You may decide to use different engagement partners with a different team. Okay, so different engagement partners with a different team, so that these people are coming from different offices. For example, you may decide to use your office in Kinshasa to audit Uganda, or use an office coming from Angola to audit Uganda, if that is going to remove the conflict of interest. Okay, and you may have to maintain confidentiality by using Chinese walls. The Chinese walls means different staff in the firm carrying out the audit. Okay, so question 80 will give you some answers in avoiding this conflict of interest. Okay, question 80 was 2 hotels. But apart from looking at question 80, you can also see what is being asked in question 12. Okay, we also have question 12 here, where they're asking us the same challenge here in question 12. So 12 is here. We are told you are the audit manager in NAB, which specializes in audit of retailers. The firm currently audits Goofy, a food retailer, and Goofy's main competitor, Mickey. So you're auditing Goofy, and Mickey has approached the audit for you to act as the auditors. Both companies are highly competitive, and Goofy is concerned that if NAB audits both companies, confidential information could pass across to Mickey. So Goofy here and Mickey are in the same business. So you have been auditing Goofy. Now Mickey has also approached you. Now they're all in the food business. They're all food retailers. Okay, they're all food retailers, and he's afraid that if you start auditing Mickey, then the confidentiality that we have just looked at is likely to be breached. So how do you avoid this conflict of interest? What do you do? Explain the safeguards that your firm should implement to ensure that this conflict of interest is properly managed. What do you suggest? What are your suggestions? Yes, I can hear you have the answers. All I will tell you is make reference to which questions on the list. I know you have the answers, and you will find them. 12 and 8, I don't have to say much. 12 and will bail you out, how to resolve the conflicts of interest. Okay, so question 12 and 80 will prepare you on how to resolve the conflicts of interest. Okay, so let's move on. That's not a that's not a very big problem. Now let's move to auditing standard auditing standard 500. I need to get it out of the way. I need to start discussing it. Audit evidence. Now, before the auditor expresses his opinion, he must collect audit evidence. Now, the three things that you must start to prepare for in auditing standard 500 are: one, what are the methods that auditors do use to collect audit evidence? Then audit evidence must be sufficient and audit evidence must be appropriate. When we talk about sufficiency, we mean quantity. When we talk about appropriateness, I mean so many things. I mean whether the evidence is relevant, whether the evidence is of quality. So sufficiency is quantity, appropriate, relevant, quality. Now, we need to be able to explain these terms. And then we also need to be able to explain the factors that determine whether evidence is sufficient and whether evidence is appropriate. We need to be able to explain this, in addition to understanding the methods that are used to collect audit evidence. Now, when you go to the LMS, you are going to find auditing standard 500 with a lot of documentation. There's enough literature to talk about all that I'm talking about. It's all there. For those that like to read, you can go and read about the methods, which I'm going to talk about anyway, so you'll find them in standard 500. Those that like to understand what is sufficiency, you'll also find it at 500, which I'm going to talk about. And of course, quality and the factors. But to me, I'm more of examination oriented because I answer questions in the exam, not notes. So I need to deal with all these questions, prepare me for audit evidence. When I've dealt with these questions, then I'm good to go. It doesn't matter how much you read the standard. If you don't answer the questions that I've just circled, then you're out of the race, even if you read the standard a million times. Okay, in exams, we answer questions, not notes. Okay, so I'm more concerned with what are you going to ask me as far as auditing standard 500 is concerned. And these questions are my notes. So I go to question 300. What are you saying about audit evidence? So by the time I'm done with these questions, definitely I will have answers as far as audit evidence is concerned. So moving on to question 30. What is this thing called audit evidence? Auditors need it to express their opinion. Certain methods are used to collect audit evidence. So question 30 here, it says, the auditor has a responsibility to design audit procedures to obtain sufficient and appropriate evidence. So we still need to answer what is sufficient and appropriate in a minute. We'll go there. There are various audit procedures for obtaining evidence, such as audit confirmation. Now, one of the methods. So we now start answering what are these methods that are used to collect audit evidence. What are the methods? Now, in this particular exam, they said one of them is external confirmations. You confirm from external parties. You can confirm from the bank to confirm balances. You can ask a trade receivable to confirm a balance. You can ask a trade payable to confirm a balance. You can use confirmations in these areas. We will also come back to what is confirmations, but this is one of the methods of collecting evidence, audit confirmation. The other method is inspection of documents. Inspection of Documents and records, you inspect the documents. Another method, observation. You observe how things are being performed. Observation. Next, inquiry. You inquire from management about many things. How large is your company? How many employees do you have? Depending on what you're interested in, you inquire. Next, you recalculate things. Recalculation. You reperform. Reperformance. You can reperform things. See? Then you can also use what we mean by analytical review. Okay, analytical procedures. I'll talk about this a lot in future. But some of the approaches we use when we are carrying out analytical review is ratios. Have you covered ratios in reporting? Yes, P7. P7, ratio analysis. Analytical review, you can compare current year with last year. Analytical review, you can carry out percentage changes. Analytical review, you can use what we call common size financial statements. In common size, in the P&L, everything is expressed as a percentage of sales. In the balance sheet, everything is expressed as a percentage of total assets. These are analytical procedures. There are many, including everything that you have studied in quantitative methods. These can all help us in audit. From your sampling, your estimations, your hypothesis testing, all this can help us. All this can help us in linear regression, simple linear regression. All this can help us in carrying out analytical review. But more especially here, we shall examine ratios, percentage changes. This is going to be the most important for us here. Ratios and percentage changes. And then comparing last year with the current year. This will be the main techniques at this level. We call that analytical review. Okay? Analytical review, you can also compare related financial information. Related financial information, for example, non-current assets with depreciation. See, this is related. You can compare non-financial information with financial information. If I compare motor vehicles with the depreciation, see, non-financial with financial. The financial is depreciation. The non-financial is the number of motor vehicles. This is being analytical. Okay, a bit of experience here to apply analytical procedures. But non-financial information with financial. Number of employees, I compare that with salaries and wages. This is financial with non-financial information or related financial information. Or for that matter, ratios and then percentage changes. So these are the methods for collecting audit evidence. External, confirmation, ask the bank to confirm the balance. That's the confirmation. Ask the receivable to confirm a balance. Ask the trade payable to confirm a balance. That is external confirmation. Inspect documents, observe things being done, inquire from management or some relevant officials, recalculate things, reperform, analytical review. These are the methods used to collect audit evidence by external auditors. Now we have a question here. Apart from external confirmation, but the exam is not going to say apart. It will ask you to explain it. State and explain 5 procedures for obtaining audit. 5, state and explain. The question was state and explain. Now, the exam here was 10 marks. But in part B, they were saying for each procedure up here, each method of collecting evidence, describe an example that is relevant to the audit of purchases and other expenses. Where do we find purchases and other expenses? Purchases and other expenses are found where? Yeah, P&L.
P&L.
Yeah, my understanding, these have debit balances. So they want us to apply these techniques They want us to apply these techniques. Give an example. External confirmation, analytical review, inspection, observation, inquiry. What's the other one? Recalculate, and then re-perform. So they want us to apply these techniques to purchases and expenses. But I'm not going to limit you to that today. I just want you to give me an example of each method here. Where would you apply it? Just tell me where you would apply each of these methods. For now, let's understand the methods. Where would you apply these methods of collecting audit evidence? Where would you apply them? Give me an example. Anything in an organization, tell me. External confirmation, what would you confirm? External confirmation from trade payables, from suppliers. So you can confirm a trade payable balance. Trade payable balance. Okay, that's okay. You see, you're applying the technique. Tell me more things here. Let's apply it. Let's get an example for each technique here.
Inspection of documents.
Which documents are you going to inspect?
The invoices, occurrence of transaction.
Yeah, very good. That is good. So I am very sure that if I show you how it is done, you'll be able to deal with it. So the question is here, the answer to question 30 is here. You see, this is the green book. Method, procedures to obtain audit evidence, and an example to each as far as auditing purchases and expenses. You see, there is inspection here, there is observation, there is inquiry, there is recalculation, there is reperformance, analytical procedures. So they have given you all the methods here, and they have even shown you how to apply them in the organization, how to apply each technique. So what I'm requesting is that you should start getting acquainted with these procedures. Okay, we are going to look at many numbers. So first of all is question number 30. Okay, question 30 in the green book will help you to understand these methods and how they applied. Let's move on. Question 47. So those are the methods, and we'll continue to see them as we move along. So let's see what 47 has for us. So let me see whether 47 can help us understand this today. Yes. So in question 47 here, part A, I'm only interested in part A. That's the one we can deal with right now. We are in position to deal with part A. In the context of auditing standard 500, explain the term and describe the key factors affecting sufficiency and appropriateness of audit evidence. I told you in the exam, they're going to ask you, what do we mean by, this is a big examination question. What do we mean by audit evidence being sufficient? And what do we mean by it being appropriate? And what are the factors? What drives quantity? And what drives quality? That is big business for the examination. And 47 will bail me out here. Every time you read something and you have no question coming out, then you are not ready. So here we have the definition of sufficiency. Now, of course, I'm not very comfortable with this question, so I'll have to back it up with another. But sufficiency of audit evidence is a measure of quantity. And the quantity of audit evidence is required. The quantity of audit evidence required is affected by the auditor's assessment of risk and also by the quality of such audit evidence. So he has only given us two factors here. Only two factors affecting, according to this question, he has only given two factors that affect sufficiency. One is quality and the other one is risk. assessment, the amount of risk that you have assessed, and the quality of audit evidence is going to affect sufficiency. Okay, so those factors are not enough. We'll look for more. We're going to look for more in a minute. Now, what do we mean by appropriateness? Appropriateness of audit evidence is a measure of quality and its relevance and reliability. So they're adding another term here. Appropriate, relevant, quality, reliability. Reliability. All this is the definition of in providing support for conclusions on which the audit opinion is based. Relevance deals with logical connection with the purpose of audit procedure and assertion under consideration. Purpose of audit procedure and assertion. I will come back to assertions. The relevance of information may be affected by the direction of testing. Reliability is influenced by the source, the nature of information, including controls over its preparation and maintenance. So what is the source of evidence? What's the nature and what are the controls? Okay, this will become clearer with the subsequent question. Let's look at 53. Let me see 53, whether 53 will give me a better explanation. That was not adequate. Doesn't cut it, but 53 may. So question 53, we will not cut it for now. 57. What was the other one? 58. 58. 58 may help me. 4 factors that influence the reliability of audit evidence. Question 58, reliability of audit evidence. This is the same thing as appropriate and so on and so forth. Reliability. So the factors on reliability are here in 58. So 58 will give me the factors that affect reliability. So let's go to 58. Factors that affect reliability. We are not yet even done with quantity, but now 58 provides me with the factors that affect reliability, appropriateness. They are here, 58. So what are the factors? 1, this is it. Reliability is influenced by source and nature of the nature and source of information affects reliability, including the controls over its preparation and maintenance. So if you want to know whether information is reliable, first of all, you need to look at the nature. Okay, if you are looking at reliability. If you're looking at reliability, you need to look at the nature of the information. What's the source? Is it? So reliability, we need to look at the source of the information, the nature of the information, and then the controls over the preparation and the maintenance of the information that you want to rely on. Reliability, because you see an audit and you want to know whether the information is reliable. So what is the source? What is the nature of the information? And then what are the controls over the preparation and maintenance? Okay, so continuing, 4 specific factors influence reliability. Okay, so these are the factors that influence reliability. The first one, audit evidence from external sources is more reliable than that obtained from the entity's records because it's from an independent source. Is that correct? Is that correct? Yeah, because we are looking at sources. We are looking at source nature and controls. So first of all, external sources. The exam is going to ask you about reliability of audit evidence in question 58 here. Question 58. Are the factors about reliability of audit evidence reliable, appropriate, relevant? First of all is external information. So if I want a bank balance, where do I look? Bank balance. If the CEO tells me that their balance is 1 billion, should I believe him? If the CFO gives me records that show that they have 1 billion in the bank, should I believe them? Where should I be looking? At the bank. Why the bank? Because the bank is external and the bank is independent. Next, Evidence obtained directly by auditors is more reliable than that obtained indirectly. Of course, you can only believe yourself because you're the external auditor. Nobody is going to give you evidence that is better than that prepared by yourself. Not so. Next, evidence in form of documents or written representations are more reliable than oral. Yeah, because you see, oral presentations are very difficult to keep. Somebody tells you in the corridor, we are 500. When you ask him tomorrow, I didn't say that. I didn't say that, and I've never said it. You see? So you see, we need documents, paper, electronic, that is more reliable. Next, original documents are more reliable than photocopies. You see, as auditors, they don't like photocopied information. Photocopies, you change all these things, and you see. So these are the factors. Now, evidence created in the normal course of business is more reliable than evidence created specifically for an audit. So, want evidence that transpired during the course of the business in the year, not the one which you are going to sit in a room and then manufacture. You manufacture cash book overnight. Yeah, so we need evidence from normal course of business. Next, evidence obtained from entry record is more reliable than the related control system, operates effectively. Okay, so we need it for evidence from records. So this is what the exam question is going to ask you about reliability. When they ask you factors on relevancy, this you must have seen in question number 58, factors affecting reliability. Okay, so we move on. Next is 65. 65 is likely to give me something about quantity. So let's move to 65. 65 here. So you are the audit of Bears World, a company which manufactures and sells small toys. Now you are planning the audit of Bears, and you are considering using some of the procedures for gathering audit evidence recommended by auditing standard 500. These are the methods. The auditor has even told you what the methods are. You know, this is a question way back from 2005, when the auditors were still young. Today's examiner cannot list for you the methods. The examiners in 2005 were still young, just like yourself. It was about the same time. They have now mutated. They are very different. They cannot ask you, they cannot list these procedures for you. No, they cannot list them for you. But the question was, for each of the above procedures, explain its use in gathering audit, and then describe one example from the audit of Bears World. So this is a free question. And then discuss the suitability of each procedure for Bears World, explain the limitations of each procedure. So you see, this question number 65 is about asking you about the procedures. What are the procedures? What are the procedures? So what is in 65? So let's see the answer to 65 here, which explains the methods. Bears World, here we are. So the methods are here. One of them is analytical. And I've asked you, have you done ratios? Yes or no? P7. What are the category of ratios? P7. What are the ratios? Categories of ratios?
Current ratio.
Profitability. Liquidity. Efficiency. Market ratios.
Ratios.
Which ones? Those are the ones. These are the ones. What about gearing? Yes or no? Yes. Or leverage now. So which one ratio is under leverage? Some call it leverage. You call it gearing. Let me introduce my own term here, long-term solvency. Tell me, what are the ratios under leverage? Debt to equity. Fine. Debt to equity, I agree. Tell me, I'm listening. Let me hear. Debt to equity. What else? Because it's a big tool for analytical review. I'm listening. Debt to capital also. Interest cover.
Debt to assets.
Which ratio is that?
Debt to assets.
Debt to
Debt to
assets.
assets ratio.
Debt to assets. What is that ratio measuring? Debt to assets. What are we trying to understand? Debt to assets? Profitability. Which ratios? Return on capital employed. Return on equity, gross profit, margin, operating profit, margin, net profit, margin. You see, they're all margins because the denominator is what? Is sales. They're all margins, not so. Yeah. Profitability ratios. Liquidity, which I may call short-term solvency. What ratios? Current ratio, and then acid test ratio. Yes. Next, efficiency. Which ratios under efficiency? Trade payables what? Okay, days or period. Trade payables days or period. Okay, trade payables turnover. So you also want the turnover. Fine. Same thing. Inventory days. And when you have the days, you have the turnover. And then debtors days. Debtors days or your receivable days. Okay. You can also have your asset turnover. Your asset turnover ratios. Okay. So these ratios you must know. This is big business for your analytical review. Okay. From financial reporting, you know what they mean. But when we are being analytical, we can also compare last year with the current year. Let us say 2023, and then we have 24 years, and we are looking for trade receivables here. Last year they were 60, this year they're 160. You need to ask questions. Why the trade receivables last year were 60 and this year they're 160? What happened? You are being analytical. Or you can do the percentage change. 160 minus 60, divide by 60. So first of all, you can look at the absolute values and ask why from 60 to 160. Calculate the percentage change. Then you ask questions. Why the increase in trade receivables? This is analytical review in addition to your ratios. So this is your technique here. Analytical procedures means the study of trends and ratios in financial and non-financial information. And we shall use it in audit planning to identify risk and to gather substantive evidence when we are carrying out our substantive procedures. This will become clearer when we study our risk. Okay? And you can see, you can do it for gross profit percentages here at Bayer's World. Then you can also come to inquiry. There are a lot of things that you can inquire about. Inquiry means requesting for information from individuals in the company, oral, written, and so on. In the Bayer's World, you can send a confirmation letter to the company's bank. Or maybe you can inquire from management about what you want. You can inquire about their cars and all the things they have, provided you explain what you're inquiring about. Remember, the question was explaining the techniques and examples. Then you have inspection. What do you inspect in the Bayer's World? What can you inspect? Then you have observation. What can you observe? And then you have recalculation. What can you recalculate? You can recalculate depreciation, not so. Yeah, you can calculate depreciation, you can calculate interest in the bank. So the question was about the methods and how you can apply them in a scenario. So this is a fair question, number 65. Okay, so you need to look at question 65. It will help you on the methods. If you're struggling with the methods, you can look at question 30 and then 65. It will help you with the methods. But you can also go to the LMS because there's some notes there. Now, let's look at 71 because I'm still interested in the factors. I'm still interested in factors that affect quantity. Let's go to 71. Now, if you look at question 71, it should help us with the quantity. So 71 is here. And if you look at what they're asking here, they are saying, describe the factors which influence the auditor's judgment concerning sufficiency of audit. So this time they're asking about sufficiency. They're not asking about reliability. Sufficiency. Sufficiency of audit evidence. Question 71. Sufficiency is quantity, not so. So what determines quantity? What determines the quantity the audit evidence is going to collect? In question 71, what are the factors for quantity? So I move to 71 here. '71 is here. And then I answer the question, the factors that determine sufficiency. First of all, source of evidence. This is something that is going to determine the quantity we're going to collect. The source of audit evidence. Is it the entity? Is it the third party? Is it auditor generated? The source is going to determine how much quantity you'll collect. This is a big factor. The second factor is materiality of. Yeah, we shall be studying materiality later in the evening. If an item is material, you may have to do more work around it. Materiality of an item will determine quantity. Next, inherent risks. If an item is assessed as being risky, we shall be studying risk. Problem Tuesday. If an item is assessed as being risky, then this is going to determine the amount of evidence you collect. Risk assessment. Come into an organization, you find they have assets, but they have no asset register. They have assets, but they don't verify them. The risk is high, and we need to collect bits of evidence. And then, how reliable are the accounting systems? Are the accounting systems and control systems reliable? Are they? If they are not, then we may have to collect a bit of evidence. So you see, question 71 will help you on factors. So you see the examination question on auditing standard 500 is going to center on three things. What are they? First of all, the methods. Yes? Secondly, you explain what we mean by sufficient and the factors, like in question 71. Then you explain what we mean by appropriate, relevance, quality, reliability, like in question 58. So to help you prepare for auditing standard 500, you have got these questions lined up. Is that clear? 71, including 87, including 103. When you sort out these questions, then you can start claiming that you have audit evidence under control. You have the question of under audit evidence under your control. If you don't have it, then don't claim that you have it under control. That is auditing standard 500. For now, this question should bail you out. Now, when you got the LMS, you'll find some notes on auditing standard 500. Still explaining the same thing. Methods, sufficiency, appropriateness. But after reading what is in the LMS, you should be able to sort out these questions in the green book. Okay, this should bail you out. Any question on audit evidence? Any question on audit evidence? Now, before we go for the break, an audit period is normally divided, an audit is normally divided into two periods. And you should begin to appreciate what happens in this period. Some of the items may not make sense, but by the end of the semester, they will begin to jail. An audit period, if a company has got a year end of 31st December 2023, the auditors are likely to start carrying out their audit procedures in what we call the interim audit, and then they will show up in what we call the final. Now, the interim audit with the year end of December 23, you find the interim audit may start around August, September, October. This may be the month for the interim audit. The final audit is going to take place anywhere between February and March 2024. We're getting the point. The interim audit is in 23, August 23, September 23, October 23, interim audit. For a year end of December 23, the interim takes place either in August, September, or something in 23. The final audit is going to be in March or February 24, following year 24. So the interim audit takes place somewhere during the year before the year end. The final audit will be after the year end. The examination question is going to ask you what takes place in these periods. What happens? What happens in these periods? What's happening there? That's the exam question. What's happening in the interim audit and what's happening in the final audit? What happens there? And on my list, I have the guns lined up here. What is the difference between an interim and final audit? If I come to the green book, question 8, of course, I just look at one question, the others are the same. So if I go to question 8, I will even straight away go to the answer, because the question is very clear. What happens in those periods? The question will ask you. So if I come to question 8 here, so this is question 8, and you can see there's a long list here. There's a long list of procedures. What is happening during the interim audit? Main procedures and practices during the interim audit, and then main procedures and practices during the final audit. So you need to reproduce this list in the examination. What happens in the interim audit and what happens in the final audit. Now, the terms that are in here will become clearer. Most of the terms have not been covered. But you should begin to appreciate that during the interim audit, the auditor is going to obtain knowledge of the business by discussion with the client management and reading relevant trade publications. You should start to understand some of the things. The client's accounting systems will be documented, or documentation prepared in the prior years will be updated. Some of them should begin being clearer. Some of them will not be. Now, when you come to the final audit, you can see that what is going to happen is that the tests that were started in the interim visit, both tests of control and substantive procedures shall be completed. And last time I told you that there are two types of audit procedures. What are they? I told you last time, and I will continue to ask you. Substantive and test of, what we substantiate? Financial statement assertions, not so. Substantive tests are for financial statement assertions. Test of control are for testing controls. Now, this is the main thing that happens in the interim audit. Okay, during the interim audit, the main thing is tests of, and then substantive tests are mainly carried out in the final audit. So I told you last time. So this term should begin to become clearer here. Okay, see whether you can appreciate them. If you don't appreciate them, it's okay. But begin to appreciate the difference between an interim audit and then a final audit. Okay, if the terms don't become clearer, please leave them. We'll come back to it. Okay, we'll come back to an interim and final audit, but you know it's on the list here. It is waiting for you. Okay. So we are now going to break off and we resume at what time? Yes, 6. Now, when we come at 6, we shall be moving to auditing standard 300. We need to plan the audit. Okay. Auditing standard 300 is about audit. Planning, the auditor must plan his audit. And we need to answer 3 questions here for the examination. Why plan? Why do we plan? Why should the auditor plan the audit? Exam will ask you, why plan the audit? The exam will ask you the difference between an audit plan and an audit strategy. What is the difference between an audit plan and audit strategy? And then what are the contents of each of these? These are the 3 questions we need to answer for the exam. Why plan? What is the difference between an audit plan and audit strategy? Because the auditor must have an audit plan and they must have a strategy. What's the difference? And then what are the contents? Even when they look similar, one fits into the other. What do you find in this plan? What is there? The exam will ask you to answer those questions. Okay, so you take a break now. The time is 5:16, so we take a break and we start at, okay?
6:16.
Okay, 6:16, I change here. Let me change it to 16. So let's take a break and we start at 6:16. Somebody is saying 6.
Excuse me, sir. Excuse me, sir.
Right, so let's continue. So before I move to audit planning, let's look at auditing standard 260. Now, the name of the standard is communication with those charged with governance. So the question is the exam is going to ask you, why do you communicate and what do you communicate about? Now, those charged with governance, of course, this is your management, this is your board. So the auditor communicates with them, and what does he communicate with them about? You'll find the details in LMS, but looking at our document here, communication with those charged with governance. So the standard is 260. And come the list here, number 34, okay, area number 34, Green Book, question 58, part B, communication with those charged with governance. So if it is the Green Book, so let's go to question 58. This is what they will ask you in the exam, 58. This is auditing standard 260, straightforward standard. So question 58, you will be asked 260, communication with those charged with governance deals with the auditor's responsibility to communicate with those charged with governance in relation to the audit of financial statements. So two specific responsibilities of those charged with governance, and then for examples of matters that must be communicated with those charged with governance. So going to question 58. So those charged with governance, these are the responsibilities. They're responsible for overseeing the strategic direction of the entity, and there are also obligations related to the accountability of the entity. The obligation is relating to accountability and overseeing financial reporting process. So this is the responsibility of those charged with governance. Now, what matters are those that the auditor will communicate with those charged with governance. Among the matters communicated will include the auditor's responsibilities, the planned scope and timing of an audit. You must explain to them the scope and the timing of an audit. Significant findings from an audit. What did you find? Okay, you must communicate to them your independence issues. Okay, you must state to them if you're having any challenges with remaining independent. Okay, so this is what the exam will ask you. Those charged with the governance, what's their responsibility? And then what matters do you communicate about? So among the matters, like I've said, is you communicate the auditor's responsibilities, you plan the scope of the audit, timing of the audit, significant findings from the audit, which will become clear as the semester progresses, and then auditor's independence. Okay, and that is your auditing standard 260. Okay, so when you go to the LMS, you'll find, I'm trying to open our LMS here, but connectivity is not good, but nevertheless, I'm trying to open here. So you have a lot of information here in 260. Okay, you have 28A, B, and C. All these are documents that will guide you in understanding 260. It's a very brief standard. I'm trying to open the material here. So I've succeeded with the one document here, which summarizes 260. So you'll find this in the LMS, communication with those charged with the governance. So the standard defines those charged with the governance as persons, for example, corporate trustees, responsibility with overseeing strategic direction and obligations related. So this is what they were asking you in the number in 58A. Okay, they were asking you about the responsibilities of those charged with the governance. So that is the first thing you'll have to explain. Then after explaining, then you will have to communicate. You will have to tell us what you communicate with those charged with the governance. That's the other bit that they were asking you. Okay, they're asking you. So 260 requires the auditor to determine the appropriate person within the entity's governance structure to communicate. And once you have done that, after determining who to communicate to, then you discuss the matters. You tell us the matters that you discuss with those. Which matters are you going to communicate? Okay, and they're quite a number. Then after discussing the matters, so you're able to see the responsibilities of those charged with governance. First of all, who is charged with governance, that you must explain. Then what are their responsibilities? And then what do you communicate about? And then now we also need to talk about the communication process. Okay, the communication process. So first, the auditor must understand who is charged with governance. And then what are the responsibilities? And then what do you communicate about? And then what's the communication process? So going back here, we define Those charged with governance, who are they and what are their responsibilities? Overseeing strategy direction of the entity and obligations related to accountability of the entity. This includes overseeing the financial reporting process. Then standard 260 gives us some objectives. Among them, what is the auditor required to do? Of course, you have to determine who is charged with governance. You have to communicate with them. Then what matters do you communicate? There's a long list here, as was the question in 58B. And then lastly, what's the communication process? What does the auditor do? According to 260, requires the auditor to, 1, shall communicate with those charged with governance the form, timing, and expected general content of communication. So how are you going to communicate with them? You should agree on the form and timing and expected general content of communication. If the auditor professional judgment conclude that oral communication with respect is not adequate, then communicate the same in writing. So you may want to document audit risks. The auditor, in case of listed entities, will communicate about independence, communicate on a timely basis, and the auditor shall assess the adequacy of two-way communication with those charged with governance and its effect. Shall assess the adequacy of the two-way communication with those charged with governance, its effect on not assessment of risk, and ability to gather sufficient and appropriate audit evidence. And then you must document the same. Okay, so where matters required by this standard to be communicated are clearly communicated orally, the auditor shall include them in the audit documentation. We shall be studying audit documentation. Those are working papers. You should document to who, when, and to whom they were communicated. Where matters have been communicated in writing, you shall retain copies of communication as part of your audit documentation. So in other words, you must document what you have communicated. Okay, so make sure you also maintain a documentation. You also maintain documentation of what you have communicated. You must document it. Okay, so standard 260 is not big. Small document here. Make sure you know it in and out. What do you communicate? Why do you communicate? Who do you communicate to? You see, what are the auditor's responsibilities? So go through the themes in this document here. Who is charged with the governance? What are the objectives there? What's the auditor required to do? What matters are communicated, communication process, and then you go through that. Okay. Now, if this then you could also make use of this document, communication with those charged with the governance, 260. So we'll still give you the same information. You have about 3 documents there. So it still covers the same things, okay? In case you want to know more, you will still need to know those who are those charged with governance, matters to be communicated to them, the communication process, and then the documentation. So there are 4 things that you have to look at. Okay, so you may either use the other summary, or you may refer to page 11 here. You may look at these here. Who are those charged with governance? Okay. Then matters to be communicated. What matters do you communicate with those charged with governance? And then what's the communication process? The auditor shall communicate those charged with governance, the form, timing, and expected general content, forms of communication, timing of communication, adequacy of the communication process, and then you document. So that is all you need to know. You can also refer to this document, but those are the themes you should know in 260. And then you answer question. Which question? 58B. Okay, so read that, read this document. You can either refer to 28A in your box, or 28B or 28C. So you have 3 documents there to help you with the standard 260. You can either use 28A, B, or C. They're all in the LMS. Okay. So you prepare yourself for standard 260, communicating with those charged with governance. So any small bit they bring in the examination, make sure that you understand it. Okay, that is 260. Not a big standard, but make sure you know it. So I'm trying to open your LMS here. You have got two documents here that concern audit evidence. 36A and 36B. I'm trying to open them. Okay, the things we are discussing before the break. I'm trying to open these documents. Okay, before the break, I was talking about auditing standard 500, audit evidence. And we had said you need to know the methods to collect audit evidence. You need to be able to discuss what we mean by sufficiency and then appropriateness before the break. And we looked at the questions. Now in your box, because I showed you the questions, but in the LMS, you have got two documents there, 36A and 36B. Okay, 36A and 36B are all on helping you to understand the methods further, what is sufficiency and what's appropriateness, in accordance, in addition to the questions which I looked at before the break. Okay, you can always look at these documents in the LMS. Okay, one document has opened here on audit evidence, so it is finally here. So borrowed from one accountant. So evidence is anything that can make a person believe that a fact or proposition or assertion is true or false. So in case you want to know what is evidence, but nobody may really ask you what that is. So audit evidence, the objective of the auditor is to design and perform audit procedures in such a way as to enable them to obtain sufficient and appropriate audit evidence to be able to draw reasonable conclusions on which to base your opinion. Reasonable assurance is obtained when the auditor has obtained sufficient and appropriate audit evidence to reduce audit risk to an acceptable low level. We shall be looking at audit risk on Tuesday. You need audit evidence in order to reduce audit risk. Audit risk is the risk you may give the wrong opinion. Now, what are the sources of evidence? Evidence may be internally generated, externally generated, or self-generated by the auditor. And we say the auditor uses tests of control and substantive procedures. Okay, and the auditor must collaborate evidence from different sources to reach a conclusion. Don't use one source. Okay, collaborate, use many sources. So we also talked about what we mean by sufficiency, and we talked about what we mean by appropriateness. Okay, quantity and then quality, and we saw the factors. Now the factors are here. Okay, what constitutes sufficient audit evidence? Quantity. These are the factors. We saw them in the examination question. You can also review them here. Okay, what we mean by sufficiency, what we mean by appropriateness, that is the relevancy. We have seen all that. Okay, and then before I've been asking you about assertions, but we'll come back to assertions. Okay, then I talked about reliability of audit evidence. We looked at reliability, what factors affect reliability. Okay, and then you should be able to go through. So go through these slides. What do we mean? Nature of audit evidence can take all these. These are things that you may refer to collect the audit evidence. Okay, and then we say the auditor uses tests of control and substantive procedures. We shall be saying more about this. Okay, so refer to these slides. Okay, to understand audit evidence further. These will become clearer. Tests of control and substantive tests. We still have a big discussion. Audit risk. We shall discuss the methods to collect audit evidence. We now know them. These are the methods to collect audit evidence. Okay, from inspection to recalculation, observation, inquiry, scanning, inspection of tangible assets, confirmation, reperformance, analytical procedures, and the methods are all explained here. Inspection of documents, confirmation, inquiry, recalculation, reperformance, recalculation, observation, inspection of documents, scanning, analytical procedures, and there's some examples given here. Okay, so make use of these slides. Okay, to be able to understand this, and then most especially when you come to this list, you should be able to do justice after looking at those documents, 36A and 36B. Make sure that you can answer these questions here. That's what's most important. Okay, it doesn't help us for you to read the slides and then you cannot answer these questions here on audit evidence. Okay, so the LMS for people looking for who will soon say audit evidence was never covered, please go to 36A and 36B in LMS. They will help you, and then you answer these questions, all of them, in audit evidence, ranging from what are methods of collecting audit evidence and how can they be applied to a scenario, what do we mean by sufficiency, what do we mean by appropriateness, what are the factors that drive these two. This is what the examination will be about. Okay, right. So we are fine with audit evidence. Okay, now we need to start discussing the issue of we need to start discussing materiality. There's this thing called materiality. Materiality. Okay? Auditing standard 320 is materiality. And I prefer to keep it simple and make sure that you appreciate it. So we have 6 questions, rather 3 questions, and once we can address them in the green book, then we shall be good at materiality. So let's start with the question. We have question 6, 64, and 22, and we need to understand all of them. So we shall start with 64 and then go to 6 and then 22. So let's start with question 64 because it will define materiality. What is this thing called materiality? Because we keep talking of free from material misstatements. Free from material misstatements. So what is this free from material misstatements? So if you look at question 64 here at the bottom, this question 64, define materiality and explain why auditors of term limited form an opinion whether financial statements are free from material misstatements. So what is this thing called materiality? Free from material misstatements. Auditors are concerned with the material misstatements. So what is materiality? Okay. So if I go to question 64 here, I will find the answer, what we mean by materiality. Just like what they will ask you in the exam. To begin with, they will ask you to define it. Before anything else, you must be able to define what is materiality. So at the bottom here, we have the definition of what is materiality. So information is material. In question 64, information is material if its omission or misstatement will influence economic users of decisions of economic users based on the financial statements. Now, materiality depends on size of an item or error judged in particular circumstances of its omission. So size, we're talking about size here. Now, materiality may be qualitative or quantitative, and I'm going to explain what we mean by quantitative and qualitative, because auditors normally look at qualitative and quantitative aspects in deciding what is material. Now, we have two types of materiality, which I'm going to explain. We have the auditor shall determine materiality levels for financial statements as a whole. So we have two types of materiality, which you must be able to explain. One is called financial statement materiality, or overall materiality. That's the first one. And then the next one is called performance materiality. And we shall see what is the difference between the two. And we have said materiality is either qualitative or quantitative. Okay? Qualitative or quantitative. And we shall see what that means. So we shall soon see what we mean by financial statements as a whole and then performance materiality. You can leave that for the time being and we shall come back to that. Now, materiality is normally based on benchmarks. Okay, it's normally based on benchmarks. When the auditors are deciding what is materiality, they normally use benchmarks. And these are the ones we're going to discuss, benchmarks. So the normal benchmarks that are used for your examination and in practice is profit before tax, total assets, and then revenue. These are the benchmarks that the auditors normally use basis for their materiality. Okay. Now, when they decide, of course, they are going to have to decide on the benchmarks which are reliable. They need benchmarks which are reliable. Okay. If profit is moving up and down, that may not be a reasonable benchmark. You see, if revenues are up and down, that may not be a reasonable benchmark. Okay, so they need to decide depending on the business which of these benchmarks to use, but they need a reliable benchmark. Now, normally, for profit before tax, we normally want a range between 5 to 10. You can choose any percentage here as your materiality, which means if a company made a profit of $100,000, an auditor may decide that anything which is 5% of $100,000 is material. Or he may decide that anything which is $10,000 or 10% is material. So to him, $10,000 may be his materiality. Another may say, my materiality is $5,000. Now, materiality is a matter of professional judgment. One auditor may use 5,000, another may use 10,000, but they're going to look at a range between 5 and 10. Now, this one you must start to memorize. Okay, these are established thresholds. Though materiality is professional judgment, you're not going to take 1% of profit before tax. That is not normal accepted practice. You can choose a percentage anywhere in between here. One auditor may go for 5%, another one 6%, another one 10%. So profit before tax is a benchmark, and then a threshold may be anything between 5 and 10. Now, when you come to total assets, we normally use the threshold of 1 to 2%. So if my total assets are $10,000, I can take 1%. 1%. Okay, and that is going to be $1,000 as my threshold. Another may say, no, for me, it is 2%, which means my threshold is $2,000. Anything which is above $1,000 is material. anything above $2,000 is material. It's a matter of professional judgment. Okay, looking at the circumstances, what you know about the business, the industry, this is what will determine materiality. So the benchmark could be total assets. Now total assets are in the balance sheet. Now this is accepted practice. Somebody is going to choose a percentage between there. One may use 1, another 1.5, another one 2. Professional judgment. Now, if you didn't use total assets, you can use revenue. And when you use revenue, we choose anything between 1.5 and 1%. So it means if my revenue is $100,000, I may take 0.5%. You see, 0.5% is $500. Another person may say, no, for me, I'm going to settle for 1%, which is $1,000 as my materiality. Now, revenue is in the P&L. So revenue is a possible benchmark. And this is an acceptable threshold. Okay, this we call threshold. Revenue we call a benchmark, the percentage we call a threshold. So you may be required to just calculate simple materiality in the examination. Tell us whether something is a material or not. Now these thresholds you must begin to memorize. For revenue, we normally take 0.5 to 1 of revenue. Don't change it. Don't say yours is 100% or 50%. No. For revenue, we normally go for 0.5 to 1%. For total assets, we go for anything between 1 to 2. And then for profit before tax, we go for anything between 5 and 10%. These are the common benchmarks. Don't introduce others. Profit before tax, total assets, and then revenue. So somebody is going to say, okay, total assets of, we have a company XYZ, and total assets was $100,000. This was total assets. Now in the balance sheet, you have debtors. Debtors are 30,000. Debtors are 30,000. Are they material? Total assets is 100,000. Debtors is 30,000. Are they material? So to find out whether they're material, I will take 30,000 divided by 100, and that gives me 30%. But I know that the threshold for total assets is anywhere between 1 to 2%. So if I get 30%, then it means debtors are material. You see, that's how we do it. Somebody would have said, no, for me, I want to really see the thing, so I multiply this by 2%. I know 2% is $2,000. So of course, if I have 30,000, then that, of course, that is material. So it depends how you look at it. You may want to take 2% of 100,000, and then you have $2,000, and of course 30,000 is material. Or you may divide 30,000 by 100 and get 30%, and then compare 30% with 1 to 2, which makes it material. So we may see that advertising expenditure in the P&L was $10,000, and the company made a profit before tax of $100,000. Is it material? We know the threshold for profitability is anything between 5 to 10%. So what I will do, I will take the 10,000, divide it by 100,000, and that is 10%. So which means that is material. Okay, it is material because 10% is in that range of materiality. It's above 5% or 6 or 7 or 8 or whatever. What we're saying is that the auditor's choice will be anywhere in between there. An auditor can go for 5 or 6 or 7 or 8 or 9 or 10. You choose what it is. Professional judgment. So you may find that research expense was $10,000. The company made revenue of $100,000. We know the threshold for revenue is 0.5 to 1%. So as research and expense material, get 10 divided by 100,000, you will find it is 10%. If you compare it with this, then that means research and development was Material. So that's how you will be required to do it in the exam. You need to memorize these percentages here. Revenue, half to 1. Profit before tax, 5 to 10. Total assets, 1 to 2%. Okay, so that's how we calculate quantitative material. This is quantitative. That's what they mean by quantitative. You see, this is what we mean by quantitative. Okay, quantitative materiality. Okay, benchmark. So here, summary, you have the benchmark. Then we have the threshold. So total assets are half to 1. Revenue, half to 1. Total assets is 1 to 2. Then profit before tax, 5 to 10. This you must memorize. Don't change them. So we now know what are the benchmarks for materiality, and then we know the threshold. We now know the threshold. Remember, anything if omitted or misstated will affect users. That's what materiality is. You see? And now these are the percentages that auditors will be using for quantitative materiality. Now, some items are material just by being qualitative. Okay, we don't even have to look at quantitative things. They are material because they are prone to being abused, and so they are material by nature. We don't even have to look at the size. Directors' emoluments, what directors pay themselves, that is material. Qualitatively, you don't even have to look at the quantitative measure. Some items are material by looking at qualitative measures. Directors' emoluments, auditors' fees. These are things which are material by simply looking at, by their existence, they are material. You don't even have to take into consideration. Now we have something called related parties. Related parties, okay, these are taken from International Accounting Standard 24, related party disclosures. Okay, IS 24, have you covered it? No, you will cover it. Related parties are people that have got control, okay, over the reporting entity. Okay, people that have influence or control over the reporting entity are called related parties. Okay, and for you, the main related parties that you should know by now is parent and subsidiary, because the parent has got control over the subsidiary. Have you started consolidation? Yes or no? Have you consolidated? P7, I'm still asking about P7. Have you consolidated?
No.
That is a big no. I know why that no is big, because you don't want me to ask questions. Okay? So a parent controls a subsidiary, as you will learn. So these two, parent subsidiary, so when the subsidiary is reporting, the parent is a related party. Okay? Now the second related party you should know is key members of management. Okay? Key members of management, like the CEO, the CFO. Okay, they normally call it the C-suite, the C's. Chief financial auditor, chief financial this, chief internal auditor, chief internal auditor, and all these people. These are members of key management. Transactions between the reporting entity and members of key management are related parties. So at least these two you should know, being related parties, taken out of IS 24. Now, IS 24 simply wants you to disclose two things: the relationships between related parties, and then significant transactions between related parties. That is all the standard wants you to disclose in the notes. That's what the standard wants you to disclose. What are the relationships between related parties, and then what are significant transactions? Because the reason is these transactions between these parties may not be at arm's length. Okay, transactions between related parties, because one influences the other, one controls the other, so they may not be at arm's length. Parent subsidiary, we know that the subsidiary is controlled by a parent. So let us see the transactions in the subsidiary's books, the transactions with the parent, and what is the relationship. So when we look at the books of the subsidiary, we must be able to see the parent there. Members of key management with the reporting entity. These people can control the entity. So let us see the relationship and let us see the significant transactions between the parents. So related parties are by nature material. Okay, related party transactions by nature are material. Okay, so that is the qualitative aspect of materiality. So when you see directors' emoluments, when you see auditors' fees, when you see related parties, those are transactions that are material by nature. Okay, if you want qualitative, these are material by nature, either by nature or qualitative materiality. So these ones you don't have to apply. You don't have to apply percentages to auditors' fees, to directors' emoluments, to related parties. Those ones we don't apply quantitative elements. They are material by nature. Okay, so that's the element you should know for the examination. Qualitative and quantitative. Then you should know the benchmarks and their thresholds. Now, the other bit, the last bit that you should know about materiality is the difference between overall materiality, or what we call financial statement materiality, and then performance materiality. These two, this is big business for the examination. Now, when the auditor is planning his audit, the first materiality that he sets is what we call planning materiality, okay, which is overall materiality or financial statement materiality, the one we have been calculating up there. This is determined at the planning stage. This is determined at the planning stage. The calculations we have been doing up there, the quantitative ones. But when the auditor is going to do the work, when he's doing the work, he has got to set what is called the performance materiality. So the materiality that kicks off the assignment is overall, or financial statement materiality or planning materiality. But when the auditor kicks into doing work, he must now decide on a certain other level of materiality that is called the performance materiality. And you'll find that normally performance materiality is about 75%. In some cases, it can be 50% of overall materiality. Okay, so which means performance materiality is always lower than overall materiality. So once you have decided what are your thresholds or percentages, you need to knock them down by taking 75% or 50%. That's professional judgment. You will decide what to go with. But the auditor must decide what is performance materiality. That's the materiality he's going to work with by taking maybe 75% of overall materiality or maybe 50%. That's a matter of professional judgment, and that will be your performance materiality. So if I decided my materiality was, overall materiality was 10%, if I multiply it by 75, then I will get performance materiality, which is how much? Which is going to be 7.5%. So you see, performance materiality is always lower than overall materiality. Now, performance materiality is the one you're going to work with. Okay, this is the one you're going to work with. Now, why do auditors choose performance materiality? That's the question we need to answer. You start off with the overall materiality, but then you later come and decide on performance materiality, which is normally lower than the overall materiality. Now, the answer is in your question here. The auditor shall determine materiality levels for the financial statements as a whole. That is overall materiality or planning materiality or overall materiality, whatever you call it. But we will also set lower levels for performance. Now, why does he do that? The reason is to reduce to an acceptable low level the risk that undetected and uncorrected misstatements exceed materiality for financial statements as a whole. So we have misstatements which the auditor is worried about. You see, there are two types of misstatements that the auditor is worried about: the undetected and uncorrected. Okay, these uncorrected he has seen them. These ones he has seen them, but individually they are not material. Individually they are not material, but he has not forgotten about them, but he has seen them. Make no illusions. These ones he has seen by carrying out his audit procedures. Which ones? Tests of control and substantive tests. He has been able to see some misstatements which are uncorrected. They are uncorrected because individually they are not material. Because look, I have a misstatement. My materiality is $100,000. Now I have misstatement A. I have misstatement B. This one is 20. I have misstatement C. This one is 60. When individually they are not material because each one of them is less than 100,000. But when I add them, how much are they? 90. They are still less than 100,000. So I'm not worried about them. I have seen them, but they are uncorrected, and I'm not worried about them because they are less than my materiality. So I don't forget about them. I keep them somewhere because individually they are still immaterial. But I'm worried that when I sum them up, they may go above 100. So first of all, the auditor is worried about uncorrected misstatements, that they may exceed the overall. Remember, my performance materiality here may be $75,000. My overall materiality here may be $100,000. Now I am worried that these small materiality, these misstatements that I'm keeping here, which I have seen, may exceed 100,000. So I may not see them. So I need to be worried about this uncorrected. But the more dangerous misstatements are the ones which are undetected. These ones I have not even seen. And they may escape if I work with a very big figure here of $100,000. Not so. So what do I do to protect myself and to make sure that things don't escape? To make sure that I've got a very small sieve where the big guys cannot escape, I have got to work with a lower level of materiality, which we call performance materiality. So much as you decide your overall is 100,000, you may have to work with something lower, which we call performance materiality, to cater for undetected misstatements and uncorrected misstatements, because when you sum these two, they may become a problem. They may actually exceed 100,000. So, and they may not be detected, or they may not be corrected, and they may pose audit risk to you. So to bring down audit risk, as we shall see, the risk that you may give the wrong opinion, you work with a lower level of materiality. In other words, this is a small sieve. Things cannot escape. You will be seeing many bigger things. Anything which is near 75 is material. But if you work with 100,000, some things you may ignore, and that's very dangerous. Because if you say your materiality is $100,000, it means that anything below 100,000 is not material. And that one that you are neglecting is the one that may have misstatements in there. So what you have got to do is that you have got to work with a lower level of materiality, which auditors call performance materiality. And examination question is going to test you on performance materiality. It is always lower than overall materiality. In practice, is anything between 75 or 50%. Some auditors go for 75, others go for 50%. After setting the overall, they bring it lower and get performance materiality, which is normally the one you work with. Okay, we work with performance materiality. Okay, so that is the first bit of the question you'll answer here. So this first bit of the question was to test you on what we mean by materiality. Question 64. Now, when you go to question 6, now we can see what they're asking in question 6. Now that we know what materiality is about, we can now answer all the questions. So if you see in question 6 here, what are they asking you? They are saying define and determine how the level of materiality is. That's what they are going to ask you in the exam for 5 marks. That's what they will ask you. Okay, don't look for big things. First, know how to define materiality and determine how it is assessed. And when you are discussing that, you still have to discuss performance. So what is the answer in question 6 here? Let's see what answer was thrown to us in the green book. If you still don't know where this green book is, you know, there are people who don't like using LMS. They're looking for notes. Materiality for financial statements as a whole is referred to as overall, and the performance materiality must be determined for all audits. Which one is bigger, overall or performance? Which one is bigger? Overall. In the context of financial statements, a matter is material if its submission or would reasonably influence economic decision of user. You see, taken on the best financial statement. Performance materiality is a materiality set by the auditor for particular transactions, account balances, and disclosures. Ultimately, both overall and performance are determined using the auditor's judgment on how users will be affected by misstatements in particular area. And we have talked about the benchmarks. We know profit is anything 5 to 10, assets is 1 to 2. When setting performance materiality, the possibility of a number of misstatements with low value, aggregate value must be considered. This results in it being lower than the overall. So that's what they're going to ask you examination. Question 6. That's examination question. Okay. Now, lastly, you look at this other question. Where is it? So now you can deal with questions. So let's look at what is in question 64. So if you look at what is in 64 now, here, 64 we have done. So let's look at what is in 22. What is the excitement there? What is the excitement? Define the term and determine how it is. That's what they will ask you, examination, performance materiality. So that is it. As far as materiality is concerned, deal with those 3 numbers, understand each and every detail that is in those small questions, you will be good to go as far as materiality is concerned. So you answer question 6, you answer 24, you answer 22 and 64, these 3, you will be good on materiality. Now, of course, we always have doubting Thomas. You always have doubting Thomas. We also have something for doubting Thomas. In the LMS, you have 30A and 30B. Take notes down. Because doubting Thomas will say, but where are the notes? I've seen the questions. I've seen the questions, but where are the notes? 30, 30A and 30B, you normally have doubting Thomas there. So doubting Thomas must be fed. It must be fed, otherwise it could become a problem. Didn't you hear doubting Thomas today? When did you cover that one? It has never been covered. That was stewardship. Didn't you hear today? You have forgotten before the break. Somebody asked, when did you cover that stewardship? I've never heard about it. But we could have asked the same. Where were you? So that is materiality. As we wait for these documents to open, that should be fine. Okay, as that opens, let's move on to auditing standard 300. Audit planning. So the audit must be planned. The audit must be planned. 3 questions you need to answer there is why plan? Why should the audit be planned? What is the difference between an audit strategy, an audit plan, and then what are the contents? Of course, you see it's the planning stage, and there are so many things now. The audit must be planned. So that is all things that at 500. Now, when you come here in section 19, on the list, we have these numbers on planning. It means that if you are going to be examined on planning, then this is what they are going to ask us. Audit planning. So the first question we need to answer is, why do we plan? Is it important? Should auditors plan? So in question 21, they're asking us, list the matters that should be documented when planning. I will come back to that. That cannot open the discussion. So we'll come back to that one, but I must go to a question that will open the discussion. Now let's look at 25 part A here, International Auditing Standard 300. States that the auditor must plan the audit. Why is it important to plan an audit? Why? This is the first question you need to answer. Why should the auditor plan the audit? In question 25. No, 21 I skipped. It is asking me other things. I want this one first here. Audit planning is important for the following reasons. This is found in question number 25, and I'm looking at the answer. Why do we plan the audit? This is the question, this is the answer here. Why do we plan an audit? We plan an audit to ensure that we pay particular attention to the most important areas of the audit. Materiality and overall materiality will be assessed at the planning stage. We now know what is materiality. Now, materiality will point us to the areas of the financial statement, so we should pay regard. So once we know items are material, we must pay attention to them. Planning. Planning will mean that potential problems can be identified and resolved on a timely basis. You see, when you plan at an early stage, where you're going to get the evidence, which evidence is not available, all this, are you going to use experts? You need to plan for your time. You see, so identifying problems and solving them. Planning ensures the audit is organized and managed in an efficient and effective manner. Okay? Which information are you going to require? You need to minimize time wastage. You need to save time. This can be done if you're organized and efficient. Planning assists in proper assignment of work to team members. You know which members are experienced. You know which members have experience, which members are knowledgeable. So when you're planning, of course, you'll be able to do that. Planning facilitates direction, supervision, and review of work of team members. If you plan, then you can review, supervise, and direct work. So in the exam, you should be able to explain to us why we plan an audit. Okay? Why we plan an audit. You should be able to explain that. So that is the first thing that you need to explain here. Why do we plan? Question 25A. In the green book is your notes on why we plan. But you can also go to the LMS and look for those reasons why we plan. Okay, so that is the first thing you need to answer. Why do we plan an audit? Now, the next thing is that as you plan, you need to come up with a strategy and a plan. So what is the difference? What's the difference between an audit strategy and what's the difference with an audit plan? Are they the same? Though they look the same. In the exam, they cannot be the same. So looking at question 31, if I go to question 31 in the green book, so 31 here, very good question here. The auditor will develop an audit strategy and an audit plan when planning an audit in accordance with the auditing standard, international standards of auditing. Which standard? 500. So this is the question. State the purpose of an audit and describe the matters that the auditor should consider when establishing a strategy. Explain what is an audit and give 2 examples of items that would be included in an audit plan. In practice, the contents are the same, but we need to know the difference between the two. What's the strategy? What's the plan? In question number 31A. So we need to know the difference between a plan and a strategy, because this is what the exam wants you to know about an audit plan and audit strategy. The auditor must plan his work. So that is 34, so 32 and then 31. So 31 here, part A. Very important. The purpose of an audit strategy is to set the overall scope, timing, and direction of. That's the key word there. That's the key word. The purpose of an audit strategy is to set the overall scope, timing, and direction of an audit. The scope, what are you going to do? Which areas are you going to cover? Timing, when? You see? And then timing and direction. This you find in a strategy. That's what the strategy is all about. You cannot jump into an audit. We have seen why you plan. And this is what the exam is going to ask you. What's the strategy? Overall scope, timing, and direction of an audit. That's what we mean by strategy. You see, audit strategy. Scope, timing, direction. That's what the audit strategy is all about. So you scope, what are you going to cover? That's what scope means. Timing and direction, when are you going to do what? Now, some of the matters that you may consider when establishing a strategy, because you need to come up with a strategy of an organization you're going to audit. The matters you have to consider. The question also starts for matters to consider. One of them is characteristics of the engagement, the assignment you're going to audit. First of all, you need to consider the applicable reporting framework, any industry-specific reporting requirements. You need to look at the nature of the business, availability of client data and staff. Will they be available? And then are you going to use cuts? Okay. Probably the other Sunday we shall be looking at cuts. 1st October. This you must consider in your strategy. Applicable reporting framework, is it IFRS, is it IPSAS, or local GAAP? Are there any specific industry-specific reporting requirements? Maybe it's a bank. What's the nature of the business? Is it a bakery? Is it a transport company? Is it fish farming or is it sand mining? What's the business? Availability of client data and staff. Are they around, including internal audit? Will they help us? This you must take into account. In a strategy, you must consider your reporting objectives. What is your objective as far as reporting is concerned? What's your reporting objective as an auditor? Timing of the audit, when are you going to, and then nature of communication. What are you going to communicate? When are you going to carry out the audit? When shall you do certain things? And then what are your reporting objectives as the auditor? The strategy must consider this. You must also consider knowledge gained on other assignments. If you have been auditing DTB Bank, you are now going to audit Opportunity Bank. What was your knowledge? Other engagements even with the client. And then when you carried out risk assessment, which you shall be looking at on Tuesday, what did you come up with? This you must consider. Knowledge from previous audits, risk assessment of the client. You see, all this you must take into account. Understanding the business of the client, the industry in which it is, financial reporting changes in the current year, what changes have happened, how strong are internal controls, all this you must take into account in the strategy. And then, of course, the nature, timing, and extent of your resources as the auditor. Resources, these are people you're going to use. Your personnel, their experience. Do you have a budget? Do you have a timetable? All this must be in your strategy. You get the point? So the exam will ask you, list some of the matters that you find in a strategy. This is what they were asking us. We're also going to see it in question 24. Now, next bit, once you have developed a strategy, then you come and develop an audit plan. Now, the auditor will take the overall audit strategy and convert it into a more detailed audit plan, more detailed. You see, now you need a detailed plan. You now need to attack. What you need now is the nature, timing, and extent of audit procedures. You see, the strategy was about scope, timing, and direction. Now you have an audit plan. And the audit plan is nature, timing, and extent of audit procedures. So take the strategy and then come up with a plan, because with the plan now you must agree which procedures you're going to use. What is the nature of the procedures? What is the timing of the procedures? What is the extent of the procedures? The nature, which ones? Timing, when, extent, to what, how far will you use them? So once you have a strategy, you now go down and get a detailed audit plan. In the audit plan, you must have the procedures. So the auditor will take, what is it? Need to get all this away here. So you see here, the auditor will take the overall strategy and convert it into a more detailed audit plan. The plan will include nature, timing, and extent of procedures to be performed by the engagement team in order to obtain sufficient and appropriate evidence to reduce audit risk to an acceptable low level. So now you see everywhere we are meeting the term reduce what? Reduce audit risk. So which means this is the discussion for Tuesday, reducing audit risk. On Tuesday, we have to discuss how to reduce audit risk. We know how to collect audit evidence. We have a strategy, we have a plan. So we need to reduce audit risk. All these are helping us to reduce audit risk. What is audit risk? The risk that we may give the wrong opinion. We may say when things are true and fair, yet things are true and worse. The opinion may have been true and fair, when actually it should have been true and worse, or true and bad, or true and terrible, or false and terrible, you know. So examples of the items to be included in the audit plan, we include the following. This is what you'll have in your audit plan. Because remember, the audit plan is nature, timing, and extent of procedures. So what will you have in the plan? The plan has got to be detailed. You see, you need a timetable. You need a timetable. The plan now must come up with a timetable. The plan must come up with the details of work to be allocated to team members. Who is going to do what? You must come up with audit procedures. When I talk about audit procedures here, I'm talking of tests of control and substantive tests. Every time you see the word audit procedures, tests of control plus substantive tests. This must come up in the plan. Materiality for the financial statements as a whole and performance. Materiality, you must have all of them. We have been discussing overall materiality, and we have been discussing performance, materiality. This must be in your plan. You see? So the examination will test you on these two. Okay? On the audit strategy and the audit plan. You must know the difference between the two. Okay. Now, if you go back to 24, they were asking you what should be in these documents, and we have seen them here. We can now answer 24. Was it 24? It was 21. 21 was asking us for what is in this plan here. Things that must be documented during audit planning in question 21. You see now here, you are combining the audit strategy plus the audit plan. So things that you must document. What are the things that you must document? Discussion among the audit team about the sustainability of financial material misstatements. Misstatements may be materially misstated. The financial statements may be susceptible to material misstatements. This you must have a discussion. The financial statements may be susceptible to material what? Misstatements. Now let me ask you a question here. We have got company XYZ here. They recently expanded their warehouse. They recently expanded their warehouse to the tune of $100,000. They expanded their warehouse. As far as the financial reporting is concerned, what can go wrong? And which standard is applicable here? They expanded their warehouse, $100,000. Which standard is applicable here, and what can go wrong in the financial reporting? Now, in absence of doubt, total assets in this company is $1 million. Yes? So $100,000 is what they spent. Total assets is $1 million. What percentage is that? 100,000 out of a million is 10%. And we know that total assets, the threshold is 1, 2. So which means expansion of the warehouse was material. So it's a material figure. So they expanded their warehouse. So what can go wrong as far as financial reporting is concerned? Somebody says IS 16, which I agree, proper plan agreement. So tell me, what can go wrong? What are the possible risks? What can go wrong in the books? Because this is what they asked the candidates last sitting. Question number 1. And that's why I told people to go and read the financial reporting, and they're up in arms. No, we cannot read it. We cannot read it. Why should we read it? For us, we like theory. Audit is theory. Audit is theory. We don't need the reporting. Audit is theory. That's why we skip to reporting. Audit is easier. This is what the administration was telling me. That's why they tell the administration, audit is easier. Audit is easier. It is theory. It is theory. We can escape there. So XYZ expanded their warehouse at $100,000, which we now see is a material figure, 10% of total assets. 100,000 divided by a million, because total assets were 1 million, and we see it as material. So expansion of warehouse is IS 16 proper and equipment. What can go wrong in the books? Overstatement of what? Tell me, give me the reasoning. Let me hear the whole explanation. What can go wrong? Before we go for audit response, don't go there. Just tell me what could have gone wrong. You'll tell me on Tuesday. Just tell me what could have gone wrong from a reporting angle in 16. Good. Let me hear those words. They may have capitalized. Okay, some expenses. Okay, which should not what? Which should not be capitalized. Not so. Yeah. Okay. Now, if these expenses should have gone where? The P&L, but they are seated where? So they should not be in the balance sheet. Not so. And if that has happened, it is likely that assets are likely to be expenses, profits, If expenses are understated, then profits are overstated. I want to hear the word over and under. You get the point? Which other term were you trying to introduce here? So it is either under or over. So you see, because you know the knowledge in 16, because you know the knowledge in 16, you can now be able to tell us that that this subsequent expenditure or this expenditure here, these expenses should have gone to the P&L, whatever they are. Maybe it was painting, okay, but it should not have been capitalized. Now, if those have been capitalized, then assets are overstated, expenses are understated, or profits overstated. But it can also be vice versa. Not so. They may have expensed certain items which should be where? In the balance sheet. Because remember, this is expenditure that enhances the performance of the asset compared what was originally assessed. This is the time when you capitalize subsequent expenditure. Subsequent expenditure under IAS 16. You capitalize, okay, if it enhances the performance. This was the warehouse. Okay, this was the warehouse. Now these items have been put in the P&L, which is wrong. These items should have gone to the balance sheet because performance of the entity has been enhanced. If they're in the P&L instead of balance sheet, it means that expenses are over, profits are under, assets are understated. This is the most important number that you're going to answer in the exam. And this is where, this is the only answer, this is the only things that you'll be doing in the other audit paper. What is it, 16? When you come to paper 16, this is what we talk about. So what is this business of jumping P7 to come to P9? What are you escaping from? What are you running from? It is easier.
We were not guided.
You are not what?
We were not guided.
Now you know. Now you know.
And it's too late.
No, it's not too late. It's not too late. There are just a few standards that you have to go and read. It's not late. Let us agree. You don't need too many standards. IAS 16 property plant, IAS 38 intangible, IAS 36 impairment of, IAS 10 events after the reporting, IAS 2, what is it? Inventories. Okay, we don't need many. We don't need many. Okay, we don't need many. I think this is what we need. We don't need a lot. IAS 37, very important. Provisions, contingent liabilities and contingent assets. And then IAS 23, and then IAS 20. This is all we need. Yeah, borrowing costs, accounting for. Now, this is all you need to survive. So it's not too late. You have got to look for your strategy. Well, now you're going to read these small standards. And we're not saying calculate. We're saying understand what is in there. This one you must know. It's not too late. It's not too late at all. A few weeks of discussion, you should be top. Otherwise, when we start talking about audit risk on Tuesday, so you see, there is a risk that things may have ended up in the P&L. This you'll know when you know 16. If you know 16, this one you will know. Because you will know that things have ended up in the P&L, yet they should be in the balance sheet. This knowledge you can only know if you know International Accounting Standard 16, property, plant, and equipment. Therefore, you can able to tell us that there's a likelihood. Don't say it is because you don't know. That's why you are going to carry out substantive tests. It is likely that expenses are overstated, profits are understated, and therefore assets are what? Understated. Now, once you know that, likely, then we shall ask you for audit response. We shall ask you for an audit response. This one, we shall ask you for an audit response. Now that you think that things are like that, likely to be, as an auditor, what should we do? You get the point? So on Tuesday, we shall be discussing auditing standard 315. 315, we must carry out risk assessment and understand the entity. Then 330, we have to carry out audit response. Now that we have made the discussion, now we shall come to auditing standard 330 and we ask you for audit response. If you think that is what it is, what then is the audit response? Okay, so now that's why we're saying that the audit team must discuss the possibility of sustainability of financial material misstatement. There's a likelihood that financial statements may be susceptible to material misstatements, like the one we have just discussed. Items being, expensed instead of being capitalized. Overstating assets, understating profits, and understating assets. That's the likelihood. That's the likelihood. Okay? Now, the other thing that should be in the audit plan is you must document key elements of understanding the entity. Okay? Elements understanding the entity. Understanding the entity, that you must document. After the break, we shall be discussing understanding the entity. Identified and assessed risks of material misstatement. This is big business on Tuesday. Identifying and assessing risks of material misstatement, that we're going to discuss on Tuesday. Then understanding the business. What did you understand about the business? Significant risks identified and related controls evaluated. What significant risks have you identified? What controls have you evaluated? Overall responses to address risks of material misstatement. What is your response? You see, what is the response? Let me now go back here. Now that you know that the expansion, things may have ended up in the P&L instead of being capitalized, what should be our audit response in my example here? $100,000 is seated in the P&L. $100,000 is seated in the P&L instead of balance sheet. What should we do? Let me see what you do. Just testing your resolve. We have constructed a warehouse. The money is seated in the P&L instead of balance sheet. What should we do? What should we do? What would you do? Use your knowledge on audit evidence, techniques. What would you do? No. Money was spent, $100,000 was spent. This money was spent. Yes? So you are telling me to obtain... Recalculate what? Obtain and review invoices and receipts. That's what somebody telling me here. Obtain and review the receipts. Not so. To understand the nature of expenditure. To understand the nature of expenditure. You see, these are the things you're going to learn. Audit responses. Not recalculate. Recalculate what? Obtain and review. You see, we are now using our techniques of audit evidence. Receipts and invoices must be reviewed. What do you want? Nature of expenditure. What's in the P&L? What's in the balance sheet? This you can only understand by looking at the invoices and receipts. You get the point? This is auditor. This is the responses we shall be looking for on Tuesday. Don't worry about them. We shall learn how to do this on Tuesday. You obtain and review the receipts and invoices or bills and quantities, as somebody said, whatever it is, to understand the nature of expenditure. This is the starting point. You see? Remember, I'm using audit evidence. What have I done here? You can see that I'm inspecting documents. Not so. I'm using inspection. I will discuss with the management or inquire from management about the nature of expenditure. What have I done? You can see I've reviewed the receipts and what? And invoices. Here, I am now discussing with the management. I am inquiring from management, from relevant management, which shall add the word relevant, because I'm not going to ask the head of security about a warehouse construction, not so. Or marketing manager to disturb him about the warehouse. His job is to sell the goods, not to construct warehouses. So discuss with the relevant management about the nature of what? You see, I'm discussing, I'm inquiring. This is audit response. We shall learn how to construct this on Tuesday. So first you identify the risks and then you give response, but that is for Tuesday. Let me go back to our audit planning. You include the nature, extent, and timing of further procedures. Where reliance is to be placed on effectiveness of controls from previous audit, conclusions on this, on how this is appropriate, must be included. So you see here, they were testing you on what do you include in an audit plan and audit strategy. So please, can you start answering these questions on audit planning and strategy? I think we have addressed what I wanted to deal with audit planning. The rest I don't want to deal with now. It is a bit too early. Okay, can you start addressing these questions here on audit planning? These ones, they all answer the same thing. Okay, some of them get more practical, but we shall deal with them as time goes on, because they take a deep dive in a case study, how to still do the same thing. They're all testing you about the same thing. Either they're asking you, why do we plan? The question is not going to change. They're either asking you, why do we plan? Why plan? Audit strategy and plan, which question did we look at? 20 what? Strategy and plan, which question were we reviewing? 20 what? 20? 25. And we also looked at 21.
31.
31. Yeah, 24 and
31.
yeah. They're on the list. Now, in those ones, we're also able to see the content. That's what they are going to ask you on audit planning. It's a simple area. That's what they will ask you. So before you go for examination audit planning, do you know why we plan? Do you know what is the strategy? And do you know what's the plan? And do you know the contents of a strategy and then a plan? Okay. Now, the last stage we shall discuss is to extract them from a case study. They will give us a case study and then we need to come up with the content. Still with the same thing, but we need to apply it in a case study situation. But we shall be dealing with the contents. And that's what they will ask you on examination as far as audit planning is concerned. Nothing more. So when you look at these questions here, they're all asking you the same thing. Okay? They're all asking you, why plan? They're asking you, what is an audit strategy? Okay? They're asking you, what is an audit plan? They're asking you, what are the contents of the strategy? What are the contents of the plan? All of them, they're asking you the same thing. Whether it is 25 or 31 or 32, 31A, 32B and C, 33, 36. And then, of course, you have mock 2, question 2. Mock 2, question 2. So these questions are on planning. Okay, so if you are preparing for examination question on planning, then this is the questions you should be preparing for as far as planning is concerned. But for doubting Thomas, he can go where? LMS. Which documents in LMS? We identified them. Which ones? 30 what? They've already gone missing. 30? Which documents in the LMS? Yeah, they are here. No, we had not identified them. 29A, B, and C. Okay, 29A, B, and C, audit planning. Audit planning, LMS. Okay, for Thomas who doesn't like the questions, he can refer to audit planning 500. Which questions? 29A, B, and C, where? LMS. But even after Thomas has answered these questions, 29, Thomas must come and answer these questions. Huh? Yeah, you come and answer these questions. Don't sit in the LMS. And once I've understood these questions, then I don't need the LMS. I just need to come and hammer these questions one after the other. Now, when you sort out these questions, then you can comfortably say, I'm ready for the examination as far as audit planning is concerned. Okay? As far as planning is concerned. So that's how you're going to use this, these guidelines and the green book. You see, the guideline, the green book is not to be used, what is it, in free fall. No, there is a reason why you're reading the question. You don't read the ones you like, and you don't read anyhow. You know, everywhere and all over the place. You read with focus. If you wake up and you have a good morning and you feel that you want to refer to audit planning, you do the numbers on audit planning. Okay? If you feel that you want to go and deal with independence and ethics, then you come and deal with all these numbers on independence and ethics or conflict of interest. You see? So you have to have a balanced coverage, your materiality. You see? You have to have a balanced coverage. You see? Not only reading what you like, or audit evidence for that matter, which we have covered. You see? Yeah. Okay, the time now is 8. We take a break. And when we return, we shall be starting off with 3:15. We need to understand the entity and its environment. Okay? So the time now is 8:04 plus 15, 8:19. Okay, so let's take a break. And when we return, we need to start off with 3:15, and then we introduce 2:30, and then we call it a day. in auditing standard 315, you'll have to answer two things. That is risk assessment, and then we need to understand the entity and its environment. Okay, so this bit we shall deal with later in the week. So we need to deal with this, understanding the entity and its environment. Now the question we need to answer here is, why do we need to understand the entity and its environment? Why? What do we want to understand? And then where do we find it? Understanding the entity and its environment. Why? Then what do we have to understand? And then where do we find it? We need to answer those three questions. Understanding the entity and its environment. So coming the list here, you have got this area here, 18, which we are going to answer. Understanding the business and its environment is a component of standard 315. So first we have 24, 29, 42. 24, 29, 42. And then mock 3, question 3. So I need to deal with all those questions. Then I will have answered the question, why do we need to understand the entity and its environment? What do we understand, and where do we find it? So starting off with 42, question 42 here. Big question to answer here. In 42, part A. Explain why an understanding an entity and its environment is important. Why is it important? Why? This is the question, why? Why is it important? Tell me. Why is it important to understand an entity and its environment? Inside and the outside of that, why should the auditor understand these things? Why should he understand them? Yes? Good. To aid risk assessment. Remember, we shall be trying to understand risk assessment. And for us to understand risk assessment, we must understand the entity and its environment in detail. Risk assessment. The risk that things may be misstated in the books. The risk that we may give the wrong opinion. This will help us with risk assessment. Then secondly, what is it? Nature, timing, and extent of audit procedures will be decided upon once you understand the entity and its environment. Okay, so when you go to question 42 here, you will see what they're telling us in 42. Part A here, they are telling us that the reason why we must understand the entity first is to identify and assess risks of material misstatement. That's the first thing, whether due to fraud or error or both at assertion and financial statement level. Then it allows us to assess the reliance to be placed on internal controls. Once we understand the enter and its environment, we shall have understood internal controls. Can we rely on them? You see? A company with no asset register, a company with no asset verification, and a company that does not, that reconciles bank accounts once a year. Can we rely on these controls? That we can only do after understanding the enter and its environment. For us to design and perform further audit procedures, this we can only do after we understood and enter and its environment. Okay, and in exercising our audit judgment, in setting things like audit materiality, we can only do this if we understand the entity and its environment. So in 42, you must understand the importance. You must be able to answer the question. The importance of understanding the entity and its environment. That's the question, why? That's the question here, 42. Why? It's here. Why do you understand the entity and its environment? Why? Now, once you have understood the why, then we can now go and ask ourselves what we want to understand. So if I go to 24, here in 24, they are now asking me, in question 24, you have recently been appointed to the promoted audit manager in the audit firm of Trams. As part of your responsibilities, you have been placed in charge of audit of specs for you, a long-established audit client of Trams. So you are an audit manager in Trams. And specs for you sell spectacles. The company owns 42 stores where customers can have their eyes tested and choose from a range of frames. Okay, so these are opticians. You can go and have your eyes checked and buy frames. Now the question is, list the documentation that should be of assistance to you in formalizing specs for you, and describe the information you'd expect to obtain from each document. So you see, the question is twofold. What do you want to know and where do you find it? What do you want to know? And then where? Where is the documents? The documentation. But the question is, what do you want from this documentation? So tell me anything that you'd want to know in specs for you, and what do you want to find there? The company specs for you. What does it do? You take your eyes there, they get tested, and then you can buy frames. So they are doctors, opticians. So as auditors, what documentation shall we need to finalize ourselves with the company documentation? And then what are we looking for in this documentation? So let me hear your answers. I'm listening. Where will you look and what do you want? Let me give you an example. Let me give you mine. I will go to the website. What am I looking for in the website? I want to know their products. I want to know their location. That is mine. What is yours? I've given my source and I've given what I want from that source. Well, I need to know I can see more from the website. What is the company size? You see, the number of employees, products they have, markets which they serve. All this I can get from the website. So what is yours? The annual report. What do you want there from the annual report? Financial performance. That's correct. You want the financial performance of the company. Okay, maybe for the last maybe 2 years. So financial performance, correct. You see, he has given me the source and he has told me what he wants from the source. It means you don't know where to look in a company and you don't know what you want to know about the company. That's what it means. Yes? That's a good one. He says he wants the memorandum and articles of association. What do you want to know? Internal controls, disaster. How can you go? You need to laugh at yourself tonight. Probably if you talk of the shareholding, I agree. Shareholding of the shareholders, that you may know, or the business activities that are permitted, which means you have forgotten your law. You don't even know your law. What do you find here? I'm listening. What do you want to know about the company and where do you find it? Payroll. What do you want to know? The wage bill of the current year, number of employees. Yeah, you can find that in the payroll. What else? Purchase invoices. Now you're beginning to wake up. You want to know the suppliers. You see, suppliers of key items.
Register.
The what?
The register, we can come back when there's the including.
Which registrar? Is that a document found in a company? Would you ask that from the directors? From the bank reconciliation statements, what do you want to know? I want to know the bank. I want to know the bank balances. Yes? Go on, I'm listening, because this is testing your understanding of how companies work. Policies on what? Policies on recruitment, policies on disciplinary, policies on salary increments, etc. The source, you can tell me what you want there. The auditor will look at all these things. You're familiarizing yourself with the what is it? Specs for you. What will I find in the strategic plan? What will I find in the strategic plan of the company? Strategic direction, not so. Strategic direction. You see, what is it? Their strategic, what is it? Actions and moves will all be found in the strategic plan. So please, the question is here. Question 24 part B, take note of it because it has tormented you. Okay, so take note of it because that's what they're going to ask in the exam. And let's see what they have for you here. You see, they had a long list for you here. You can make reference to the prior audit file. You can make reference to prior year audit financial statements, budgets, organizational chart, details of store locations, staff listing, internet site, memorandum and articles of association, and many more. This list was very small, and there are many things that you can know about a company. So there was a lot that you would know about this company, a lot, many things. But the point is, you have to give the source and what you want from there. Okay, so that is answering the question of what. It is answering the question of what? Yeah. So continuing, we have, that was 24. What's in 29? Let's see what's in 29. What are they asking in 29? So about the same thing. So here in 29, they're saying, list 4 examples of matters that the auditor should consider when obtaining an understanding of 4 matters. Question 29. So you're still understanding the entity. So you move here 29 and you see what matters you should consider. 29 is here, part B. What matters? Anything you want to know about a company, its industry, applicable reporting framework, ownership and governance, accounting policies, key suppliers and customers. This one was open-ended. What do you want to know? They did not ask you where to find it. You see? This one was a young question. It was young. It was just 4 marks. What do you want to know? I think the examiner was tired when he was setting this question. He was tired. Let me ask them, what would they want to know about the company? You see? The model examiner will ask you what you want to know and where do you find it. Okay? So that was a question on what do you want to know, which was straightforward. So what is in 42 we have seen. So lastly, mock 3, question 3. Mock 3, question 3. So mock 3 is at the back. So if I got the back and I see mock 3, question 3, so this is mock 3. So this is mock 2, so we go to mock 3. So this is mock 3. So mock 3 is here. So they will say mock 3, question 3. So this is question 3. And part A, they are saying here, list 5 sources of information that would be of use in gaining an understanding of Sunflowers Limited. And for each source, describe what you would expect to obtain. So this is Sunflowers here. So this is the same thing. What do you want to know? And where would you find it? Okay. What do you want to know and where would you find it? So moving down, you go to question 3. What is it? Mock 3, question 3 here. This is question 3. And you can see there is a good table here. So this is question 3 in mock 3. So there's a table. The information sources are here. And what would you expect to obtain from there? Permanent audit file. We shall be studying permanent audit file. Okay, so this is a file where the auditor keeps things of a permanent nature on the client. Things of a continuing importance in future audits. So agreements and share certificate, things of an ongoing nature, which apply to every audit, will be kept in something called a permanent audit file. Prior audit file. Okay, the audit file of last year, it will give you some things. Prior financial statements, internal control questionnaires, and system notes. We shall be studying internal control soon. The auditor must document them. Company website, what do you want to know? Financial statements, company budgets, prior year report to management. The auditor may have given a report to management about deficiencies on the previous audit. Discussions with management. These are sources of information for the auditor. So see, you should know the sources of information and then what do you want to know from there. The exam will ask you. Okay, the exam will ask you. So which means You should be able to answer that bit of 315. Not difficult at all. The questions are there for the taking in the green book. Why do you want to understand the business and its environment? What do you want to know? And then where do you find it? Standard question. Okay. Understanding the business and its environment. Okay, lastly today, we want to look at auditing standard 230, which is audit documentation. Now, audit documentation is also called working papers. Working papers. These are the papers, working papers kept by the auditor. That is his documents. Audit documentation. Okay, so the documentation, you have two documents. You have two documents in the LMS. 35A and 35B. Okay, so when we are going to make reference to your 35A and 35B in the LMS. They have everything you need to know about audit documentation. These are the working papers. This is where the auditor records his audit evidence. So you'll make reference to this slide and these slides, and you should be able to answer any questions on audit documentation. Okay? So auditors should be able to identify sufficient, reliable, relevant, useful information. Documentation is not just a piece of paper, it is audit evidence. And we know evidence must now be sufficient and appropriate. So some definitions that you'll have to find in auditing standard 230 include things like what is audit documentation? That's a record of audit procedures, performed, relevant audit evidence obtained, and conclusion the auditor has reached, also called working papers or work papers. Now the auditor records these things in an audit file. So auditors keep files. And then we have experienced auditors. These are terminologies. Now the first question you need to answer is, why keep working papers? This is the first question you need to answer. Why? Why keep working papers? Why should the auditor keep working papers? Why? That's the first question you need to answer. Why? So you have a long list here in the LMS, 35A. But as you must have discovered now, I prefer my list here. The LMS is normally for doubting Thomas. But for us to be comfortable with the audit documentation, we need to answer these questions here. Audit documentation, working papers. Working papers. So starting with the, so we have question 7, 21, 24, and mock 2 question 4. So starting with question 7, so what is in question 7? Working papers, documents maintained by the auditor. So in question 7, we are asked 4 benefits of documenting audit work. 4 benefits of documenting audit work. Why should the auditor document his work? In auditing standard 230, audit documentation deals with the auditor's responsibility to prepare audit documentation for an audit of financial statements. So required. State 4 benefits of documenting audit work. Now these benefits are here. You can also find them here. These are the benefits of documenting work. Increasing economy, efficiency, and effectiveness of an audit. Assisting the audit team in documenting the overall strategy and planning, which we know, because the strategy and plan must be on paper. Direction, supervision, and review of audit work. You can only direct and supervise something you're documenting. You can only review what is documented. Recording audit evidence generated by audit procedures that are undertaken to justify and support your opinion. You need to record your evidence. And then the engagement team must be accountable for its work. This you can find in working papers. So the exam will ask you the benefits of recording audit work. As was the case here, benefits, question 7. So if I go to question 7, answers to question 7, here, I'll find the benefits. So the benefits are here. Benefits of documenting audit work, they're all here, question 7. The same we are seeing in the LMS are the same here. Provides evidence of the auditor's basis for conclusion about achievement of an overall audit objective. What was the basis of your conclusion? Provides evidence that the auditor has planned and performed his work in accordance with auditing standards and other legal and regulatory requirements. Assist the team to plan and perform the audit. Assist team members to direct, supervise, and review audit work. Enables the team to be accountable. A record of matters of continuing significance. It enables the conduct of quality reviews and inspections, both internal and external. Audit firms are inspected by external people from ICPAO and then internal reviews. All these are the benefits of documenting work. Exam will ask you. Now the question asks for only 4. So if they ask 4, you give 4. So this is the first thing you should be able to answer. You see? Why maintain working papers? Okay, moving on with the slides. Now that we know why maintain working papers, you have all these here. What's its importance? We know why working papers are maintained. So you can always deal with this. Now, the next thing that you need to answer is, what are the factors that determine the form, content, and extent of working papers? What are the factors? Same thing like asking you the quantity of audit evidence. How much audit evidence shall you keep? What determines the form, content, and extent of working papers that you keep? What are the factors that determine the form, content, and extent of the working papers. Form, content, and extent of working papers. Big question they will ask you. Same thing like asking you, how much working papers should you keep? How much? What determines how much you keep? And this we shall find in probably question 21 or 24. So let's look at 21 and 24. We shall find the answer. So 21. So question 21, we are asked here, and that's where the question is. List 6 factors which affect the form and content of audit working papers. What determines the form and content of working papers? Question 21. Form and content. Okay. What determines the form and content? In other words, how much should the auditors keep of working papers? How much should they keep? Form and content. So we have the answers here to 21. So these are the factors here. These are the factors that determine the form and content of how much working papers external auditors should keep. 1, is the size and complexity of an entity. The size and complexity of an entity. So if you're auditing Matabakas and Stanbic Bank, for which one shall you keep more working papers? Not Matabakas. Size and complexity of the entity. Who is bigger in size? Who is more complicated to audit? Okay. So I guess you get the point. Size and complexity of an entity will determine how much you keep, form and content of working papers. 2, the nature of audit procedures to be performed. Of course, if you're going to perform complicated procedures, then you need to document a few things. This will determine the form and content. The form and content, whether electronic, whether oral, whether manual, whether what, will be dictated by the procedures you're going to perform. Identified risks of material misstatement. The risks of material misstatement to identify will determine the form and content. Significance of audit evidence obtained. How significant is the audit evidence you have come up? Exceptions identified. Conclusions, methodology, and tools used. You see, these are the things that will determine the form and content of working papers that that you will be collecting. And if you look at our slides here, this is what they were trying to preach to you here. The form and content of working papers. So you'll find this in your document number 35A. Okay, form and content of working papers. Okay, so that question you should be able to answer. Right. Now we have types of audit documentation, the kind of things that you are going to find in an audit file, the kind of things that the auditor is likely to put in an audit file. The question could ask you, give examples of audit documentation. What are some of the examples of audit documentation that you may find? Now, the first thing you'll find is audit programs. Audit programs, these are instructions that the auditor carries out in order to collect his audit evidence. For example, if he's going to audit motor vehicles, he has an audit program to audit motor vehicles. If he's going to audit payroll, he has an audit program for payroll. Okay, we shall be dealing with this when we deal with our substantive procedures. If you're going to audit the inventory, you have an audit program for inventory. So audit documentation must include audit programs. Analysis. What did you analyze? You collected evidence, You made calculations, you recomputed things. What was your analysis? Okay, then we have what are called lead schedules. Lead schedules is the final document in every section that you're auditing. You see, if I'm auditing a bank balance, you may find that the bank balance is in section K. And the final schedule is K1. Below K1, there is K2. Below K2, there is K3. So each paper is labeled, and so on and so forth. Now, the final document in every section in a file is called the lead schedule, because that is the final, that's the summary of whatever has happened in section K. Section K could have been bank balances. Now, after sorting out bank balances, I need the final schedule, which is called the lead schedule. The others are supporting schedules. Okay, so lead schedule, issues memoranda. These are issues that you have collected. Okay, issues that have come up during the audit. Summaries of significant matters, letters of confirmation and representation, confirmation from the bank, representation we shall be studying. Representations are from management. We have a whole standard to deal with there. Checklists. Okay, the auditor has a checklist. The auditor has a checklist. You see, I used to be in an external audit many years ago. And one thing that I learned is to move with the checklist. Isn't this a checklist? Isn't this a checklist? I'm entirely checking myself. Before I go for the exam, I must be comfortable that I understand all the documentation. You know, I had a colleague many years ago who did an audit exam 6 times. He failed the exam 6 times and passed it on the 7th attempt. You know why? Because his reading was skewed. He goes to the exam, he doesn't know materiality. So when he comes back, he has to prepare for materiality. Then he goes back, they brought working papers. So what is this thing called working papers? He thought he would spot the examiner. Every time he went to the exam, he was learning something. So by the 7th time, he had read everything. Then he passed. But if you had a checklist, probably would have done well the first time. So auditors have checklists. They don't just, they have to tick off that they have done their things. They have confirmations. They have representations from management. They have checklists. They have a lot of correspondence on significant matters, emails, notes, or a conversation. Every time we talk with an auditor, he's writing. He's taking notes. These are going to be part of his documentation. The exam could ask you to list some of these. You see, examples. Okay, and so on and so forth. Now, what makes a working paper self-explanatory? In other words, what are the qualities of a good working paper? You see, a good working paper must be signed, it must be dated, and it must be indexed. That means cross-reference to other papers. Is it K1? Is it K2? It must have a number there, indexed. A paper cannot be flying without where it should be. Is it K1? Is it K2? All subsidiaries should be cross-referenced. K4 should talk to K3, and K3 should talk to K1. Lead schedules, these are the final schedules I told you in any sections. These should agree with the trial balance and financial statements. What's the trial balance? P7, what's the trial balance? Coming from where? Good. So lead schedules must agree with the trial balance. Work has been done in accordance with the audit program. A working paper should have an audit program. What did you do? Okay, time spent has been recorded. This should be a good working paper. Okay, so the exam is going to test you about the qualities of a good working paper. Okay, so these are techniques for documenting programs. So a good working paper should be clear, it should be complete, it should be accurate, well indexed, relevant, concise, neat, and informative. Now, homework. Can you go and read this slide here in the LMS 35A? Now, after you have done 35A, can you also make reference to 35B? That's if you're interested. It is also an audit documentation and audit evidence, because we have covered all this. Okay, audit evidence. Go and see go and read a few things in here. They will make some sense to you. Why audit documentation, form and content, the things we are discussing, examples of audit documentation. You know, there's a lot to pick from 36A and 36B, because when you show up next time, which is Tuesday, I will be completing the questions which I have not dealt with here. I will answer these questions and then move on. Okay, these questions. I will deal with the 24 and then mock 2 question 4. I will deal with these remaining questions. Then I move on. The assumption here is that you will have dealt with the 35 what? 35A. And B. Yeah. You join Doubting Thomas and read 35A and 35B. Read everything there that concerns audit documentation. It is straightforward, okay? So that we can move on. In case you find something that is challenging there, then we can discuss it. Okay, but whatever is there, I will still answer in the questions here. I will still go through them, but review them too. Okay, have a go at them. 36, no, this is, what is it? Yeah, 36B and 35A. Yeah, then 36B. Please review them. Review them and let's quickly go through them next time and then move on to the big thing. So next time we meet, we are going to spend a lot of time on audit. That's where the game is. Okay, so we can leave it at that unless there are questions. So by now the green book is already in the box. This checklist is also in the box.